Hey everybody, welcome to the Financial Freedom Show. My name is Rob Berger. It is Thursday at 11 a.m., so that means it's live Q&A time. So for those that are in the chat already, please give me a thumbs up if you can see and hear me. And I realize I've got sunshine blasting through. So until I hear from you, I'm just going to assume everyone can hear me and see me. A couple of housekeeping matters. Most folks that watch these live Q&As watch them after they're over. And so what I'm going to do, this one is actually going to be all Q&A. I've got a ton of emails that I've received that I want to go through, plus the questions in the chat. So we're going to talk about anything and everything. So what I'm going to do after the video is over is go back to it and I guess watch it again, as painful as that will be for me, and put timestamps below the video with the topic that was discussed and when. You can just, it'll be a link. You can just click it and jump to that topic. So if you don't want to watch what will likely be 2+ hours, some of you do, that's great. But if you don't, you can just, whatever topics are of interest to you, you'll be able to jump to them. So that's below the video for those that watch this after the live Q&A is over. My goal today, and I got a thumbs up from Ryan. Neil says he can hear me. Thank you. So my goal is to clean out my inbox. This is all about me today. I want to get to inbox 0. And that just scratches the surface. I've been telling folks in responses to emails and things that I've got literally hundreds of portfolios, questions, topics. So I move a lot of them over to Asana, which tracks it. So I haven't even gotten to that yet. I'm just trying to get rid of get rid of sounds so harsh. But reply to the ones that are in my email, my inbox. Plus, all of you folks in the chat, and I see already some of you doing it. You definitely want to tag me. If the question or topic is for me, tag me because it lights up bright orange. So like the first one is from Salty. Where's my puzzle? That's going to come at the end, Salty. I will say, and this may be bragging, but I finally went over 2,000 with my blitz rating on chess.com. 2004, and then I stopped. Like, okay, I'm done. I'm never playing chess again. That's not true, but I stopped for the day. I thought I'll at least enjoy a 2,000 rating. Now, on the downside, my puzzle rating went below 2,900. It's like in the 2,800s. You'll see that at the end of this show when I put up a few puzzles for Salty. So that's, not good. So we're going to jump right in. I'm actually going to cover a couple in the chat, and then we're going to go to your emails. We're going to be talking about, retirement accounts. I got some portfolios to look at. By the way, one last administrative thing. So last night, my wife and I went to the Halloween parade in Northern Virginia, where we live. It was, at night, and it was fun. It was great weather. And at the end of the parade, so we've been there like an hour and a half, all the fire trucks come through. They got their lights going. And this big engine, 106, I think it was, rolls by. Of course, I'm just 10 feet from them. And of course, they're moving very slow. And the firefighter driving the truck, he goes, Rob Berger. I'm like, I'm looking, it's dark. Do I know you? I'm not great with names, really good with faces. I would remember everyone's name if we all just went by a number. That would be really helpful. But in any event, I'm thinking, I don't really know this person. He goes, YouTube. Yeah, a shout out in the real world. Love it. Actually happened to me at the airport too. If you ever see me in the wild, I don't know, like at a coffee shop, please say hello. The first time it happened, I was like dumbstruck. I'm like, oh, hi. Yeah, good. I didn't know what to say. Anyway, so I see a ton of questions. So I'm going to get to them. I want to start with some questions that I've sort of pre-prepared from email. And hopefully, here we go. And these are some great questions. I think the topics will apply to a lot of people. I'm going to start with one I've covered before. And it's this whole thing between dollar cost averaging and lump sum. I actually have 3 emails just recently on this topic. One from David. He has some money on the side. He's getting a bonus. Should he dollar cost average over 6 to 12 months? Should he invest lump sum? That's his question. All right, we're going to answer that. Another listener, Herb, wrote in kind of the same question. This one was a little interesting. This has a twist to it. He said, I need to put some cash. He wants to put cash in the bond market. He's, retired, but he's concerned about rising interest rates. And of course, as we know, if interest rates go up, the value of an existing bond which has some fixed lower rate, becomes worth less, not worthless, hopefully, worth less. So his kind of a twist, but it's the same thing. He wants to know, do I wait till the first of the year? Do I dollar cost average? Do I just jump in? What do I do? And then the third one was from Ryan, and he's sold a business, has some money, and he kind of, it sounds like it's very similar situation to what I faced in 2018. One of the interesting things, sort of the twist with his question was, if I understand it, at one point, he pulled his money out of the market and he decided he was going to go back into the S&P 500 when it sunk to 1,700. Now, I confess, I don't even know. I don't follow like the number behind the Dow or the S&P. It's 45. It's 4,587 today. It's actually up 80 bips. Yeah. And what happened was it never hit 1,700. It just kept going up. And but his question, kind of the same thing. He's got this lump sum. What do we do? All right. So what I did, of course, was lump sum. And at the time, I was nervous in 2018. I would be really nervous today. But here's how I looked at it. One was, even if things are overvalued by historical standards, doesn't mean they're not going to go up more. If likewise, by the way, just because something's undervalued, one would say Citibank is undervalued today. It's trading at less than its book value. That doesn't mean it can't go down further, right? And so that's the first thing. We all know, or probably we most of us believe, that at some point there's going to be a big correction, a bear market, whatever. But I don't think any of us know when that's going to happen, what it's going to look like. Is it going to be short term, like the pandemic drop? Will it span 3 years, like the .com bubble that when it burst? We don't know what it's going to look like. We don't know what's going to trigger it. We don't know when it's going to happen. And so I thought, look, I'm investing for decades, right? Even at my advanced age, if I'm on this rock until I'm 90, I'm still a long-term investor. And by the way, if I die much, much, much earlier, it's probably not going to matter so much, the choices, right? I mean, and so I'm still a long-term investor. So I just lump summed it, right? And I mentioned in a video not that long ago that if I were doing it today, I think I'd probably still do the same thing. But I think the argument for dollar cost averaging is probably at least a little stronger. But here's the thing I think we need to, the big takeaway. One, we need to recognize that we don't know between, say, lump sum and dollar cost averaging over, we'll say, 12 months. We don't know which one's going to work out to be better. There's no way to know. We shouldn't pretend to know. Could we guess and say dollar cost averaging is more likely than not because of high valuations? That sounds reasonable to me. In 12 months, I'll let you know if that played out. We don't know. And so at the end of the day, I think we need to, first of all, recognize that assuming we're long-term investors for decades to come, the choice probably doesn't matter that much. And what we need to do is take the market timing aspect out of it. That's my view. So obviously, if we just lump sum all in, and right now we're taking the timing aspect out of it. If you're going to dollar cost average, just put it in writing what you're going to do. Every quarter or every month, whatever, you're going to put in 1/12 or 1/6 or 1/18, however long you're going to dollar cost average into the market, and you're just going to follow that. The problem comes, I think, when we think we know what the market's going to do, and we just don't. And no one else does either, even the ones that tell you that they do. And so personally, I wouldn't get too bent out of shape over this choice. If you're nervous about the market, then dollar cost average. Will that have been the better choice? You'll know when you're done. You won't know until then. It's something that Paul Merriman, he and I have talked about this issue. And he said, yeah, studies show that lump sum does better more often than dollar cost averaging, but that's just because the market goes up more years than it goes down. That's really all it is. Most of those studies don't factor on valuation. So if you add in the valuation that we're currently in, I don't know how that's going to play out. But his point is there's an emotional side to this. And people, they put a lump sum all at once and they lose 30% in a few months. It really hits them psychologically. Much more so than if you dollar cost average and at the end of, let's say, the 12 months, you think, oh, I would have been a little bit better off if I'd invested it all at once. That tends not to eat away at people as much as the potential loss. So whatever you do, put it in writing, have a plan, and do it. That's my take on it. Now, the bond thing is interesting because if you're concerned, first of all, between now and the first of the year, I would just invest if that was my choice. But there are other ways to deal with interest rate risk, right? You don't have to just, I mean, you can go with shorter term bonds, right? Short-term bonds, or maybe intermediate term, if you're okay with that level of interest rate risk. Most intermediate term bonds have durations of 5, 6, 7 years, somewhere in there. So if interest rates go up by 1%, you lose the 5 to 7%, whatever the duration is in value, short term, right? Long term, you'll eventually make it back up because as that fund is selling lower rate bonds and buying higher rate bonds, you'll eventually make it back up. But in the short term, yeah, it could go down in value. You could also split your bond portfolio between, say, treasuries or maybe high grade corporate bonds on the one hand and TIPS on the other, which if there's inflation and rates go up, they go up in value too. You could throw in some I bonds as well, which I really like, but you're limited to 10 grand a year. If you use your tax refund, your limit's a total of 15. So, if you're in retirement and you're dealing with hundreds of thousands or millions of dollars, it's almost impossible to really make I bonds, a significant part of your portfolio, at least quickly. So, yeah, I kind of favor lump sum generally. In part, because I don't know, it's just how I've done it. But I don't think dollar cost averaging is wrong. I just think you need to pick a plan and stick with it. So, all right. Now, those were 3 emails. Now I'm going to turn to the chat. I'm going to kind of go back and forth between the chat and the emails. Scott asks, this is in the chat, what is your take on digital currency regulated by the central banks? Is this the future? The banks, not the Fed, are the power players. Well, I'm terrible at predicting the future, other than that I do think Ohio State will beat Penn State this Saturday. I hope it doesn't go into 9 overtimes. I've got to believe that some form of digital currency is probably in our future. Exactly. I mean, obviously the central banks and the Treasury are going to have to drive it, right? Not the big banks. The big banks will certainly be involved. They're involved now, right, with the Fed and buying and selling bonds. So the big banks are involved now. But I got to believe some form of digital currency is in our future. What it looks like, I don't know. I don't have a prediction on that. But I do have to believe it's going to be in our future in some way. Now, the interesting thing is what will that do for things like Bitcoin? Again, I'm terrible at predicting, but Bitcoin is different, right? I mean, the reality is Bitcoin is not a currency. I know in theory it could be, but it's more like digital gold. That's how people are viewing it, in my view. It's a way to store value. It's very unlike gold at the moment, of course, in that it's incredibly volatile. I mean, of course, obviously gold can go up and down, but I mean, Bitcoin, it was up to 67, then it was under 60. Today, what's the price of Bitcoin? 61.4. So it's very much unlike gold in that respect, but it's not used as a currency. So the fact that a central bank might have its own digital currency, I don't think in and of itself, I don't know how that would play out with Bitcoin, but it doesn't seem to really interfere with what Bitcoin its purpose is today, in my mind. But of course, what could interfere with Bitcoin is regulation. I mean, we've seen China's take on digital currencies, and the crackdown on mining, and that could happen, I guess, in the European Union, could happen in the United States. I don't know. I don't have a prediction on that, but there you go. That's my take. Would love, Neil wants my opinion on unrealized capital gains proposal. So if you haven't heard, one of the tax proposals going around Washington is to tax the unrealized capital gains, basically, as I understand it, of billionaires. And I think I'm not a fan of this at all. And it has nothing to do with whether we should tax billionaires. I'm generally not, I'm not a fan of the whole approach to tax policy. If we step back, here's what happens. And I'm going to try to be as apolitical as I can. Yeah, you'll tell me how I do. Republicans, by and large, lower taxes. And the criticism of I think there's two broad criticisms of what Republicans do with taxes. The first is that the reductions, the claim is the reductions favor wealthy folks over less fortunate individuals. Okay, that's one concern. But the other one is increased deficits. And there's always this debate, well, how much does it really increase the deficit or not? Because it could, stir and encourage economic activity, which raises revenue. But I think it's pretty clear it certainly increases the deficit to some extent. So those are the criticisms. But that's what happens. You go all the way back to Bush, the younger Bush, and he lowered taxes across the board. And then President Obama came in and he raised taxes, not for everyone, but he raised taxes on the wealthier, higher income folks. For the Affordable Care Act. I say he, I mean Congress, obviously, but in his administration, Trump administration lowered taxes. Now, I think President Biden's in some ways going to raise taxes. The problem is we've gotten this vicious cycle where taxes get lowered, presumably increasing the deficit by some amount. Then they get raised, but a couple things happen when they get raised. The first thing is the increase in revenue doesn't go to say, okay, you made the deficit situation worse, so we're going to raise taxes and put that towards the deficit to try to get the spending under control. The taxes get raised and they get funneled to new programs. So between the two parties, and this is really an apolitical observation, it's like they're not working together, but maybe unwittingly they are, to make our situation pretty bad. We lower taxes, increases deficit. Don't worry, we're going to raise taxes, but none of it's going to go to the deficit. It's going to go to new programs, which then incur future spending down the road. And that's kind of where we're headed. And the second thing is there's all these tax proposals that target very specific people. I would be much happier if they said, we're going to raise the income tax. Now, no one wants their taxes raised. I don't want my taxes raised. But if they said, look, we're just going to raise the income tax and we're going to have new brackets for wealthier people. Now, I know the problem, and this gets to Neil's question, is raising the income tax rates, even if you have a special rate for billionaires or whatever, doesn't get at their unrealized capital gains. And the problem with the proposal, first of all, you're going to have to value things. It's easy for stocks that are publicly traded. What about businesses? You have unrealized gains in a private business. Do I have to value that? Well, I'm not a billionaire, so I don't have to worry about it. But do they have to value this every single year? And then what happens when they pay a lot in taxes because the market's up and the next year it crashes? They get no benefit from that. As I understand it, the proposal is they can offset gains with those losses over time, but they don't get to just get their money back. And I just think that's fundamentally wrong. It's not about, do billionaires need help? Obviously they don't. But I think there needs to be some integrity in what we're doing. And I think there's another underlying issue, in my view. There's a lot of talk about taxing the super wealthy. And I think it turns our attention away from one underlying reality, and that is that the middle class and those that make a middle class income are the ones that at the end of the day are going to have to get us out of this mess, because there just aren't enough billionaires. We could take all their money. I mean, think about it. We've got a bill that's going to be what, $2 trillion? We're talking about billionaires. We could take all their money. It would be a drop in the bucket, right? I mean, what, the richest person is it Elon? He's like 200 billion. And we could take the top 10 richest people in the US at, I don't know what it equals, 1.5 trillion. I mean, it wouldn't even get us to a single year. I mean, it's peanuts. And so this idea, I get the concept. We want everyone to pay their fair share, whatever that is. I get kind of tired of hearing that, but I get it. I mean, we want the tax system to be fair. Of course, what your fair is and what my fair is and what someone else's, who knows? But this obsession with the super wealthy, I think it can mislead people, maybe unintentionally, into thinking, boy, if we just make the tax system fair and really get those super wealthy people, then we'll have our problems fixed, and we won't. It won't even be close. It's kind of like we're rearranging deck chairs on the Titanic. All right. Rolf said or asked, what's your take on using TIAA traditional in place of bonds in asset allocation? Okay, it's a great question. And it's a great question in part because while I know what TIAA is, I have no idea what TIAA traditional is. So we get a chance to learn together. And I'll show you this on the screen. So this is probably going to take, it's a fixed annuity. Right, we can see that right here. And we have another annuity question in the emails I'm going to get to in a minute. So generally, I'm not a fan of fixed annuity, of any annuities. I did a video on annuities not that long ago, single premium income annuities. And I won't say that there's never a place for them for sure. But I'm generally, would prefer to be able to manage all of my own money. That's my own bias. As to this specific annuity, I'm going to have to dig into it. I just don't know what the fees are, what the rates are. So I'm going to have to dig into it. So I'll put that. See, once again, I come away with another to-do list, but that's okay. I will look into that. All right. Next question from the email. This is an interesting question. And I encountered this. The email, Hima, I hope I'm pronouncing that right. Love your videos. Thank you for the education and for the engaging content. I've been on the FI, financial independence journey, only for 3 years now, so still consider myself a novice. I have a rookie question for you. By the way, this is not a rookie question at all. If TD Ameritrade charges me $75 for a VTSAX purchase, should I still continue to purchase this fund? So what's going on? VTSAX is a Vanguard fund. It's the total stock market, right? You think I would know all this by now. Yeah. So the deal is, if you buy this from if you have your account at Vanguard, you don't pay anything for this fund. But if you have a brokerage account somewhere else, like in this case, TD Ameritrade, I know this is true for Merrill Edge, I think for Fidelity, these brokers will offer some mutual funds for free. But particularly with Vanguard funds and others, there's a fee. And so in this case, it's $75. So here's the deal. If you had a lump sum and you preferred the mutual fund, it was going to be a one-time purchase and you paid $75, no big deal. If this is going to be a monthly thing, a quarterly thing, a yearly thing, why pay the money, right? So if I were at TD Ameritrade, I would just use the ETF, right, version, which should be free, and it's VTI. It's the exact same fund, right? That's the thing to keep in mind. If we look at the portfolio, and let me actually open up another tab. So this is the portfolio for VTI. Now let's go back to VTSAX. I think the expense ratio may be different, maybe by 1 basis point or something, unimportant. Yeah, they're identical. 99.17 for U.S. equities, same thing. Look, we can look at the price to earnings, 19.95, same thing. We could come down to the top 10 holdings, Apple at 502 versus, watch, it'll be different. Nope, Apple at 502. So they're identical. So if you have an account, and this would be true if you were at TD Ameritrade and you wanted a Fidelity account, and the mutual fund was going to cost you, if I'm at a Vanguard or a Fidelity, I'm likely to buy their mutual fund version. But for these kinds of high volume, very liquid index funds, the ETF is great. So that's what I would do. Great question. All right, next one. All right. So this one comes from Phil. He and his spouse are basically at retirement, and he had some question. I'm trying to read this in a way that doesn't give away any personal information. All right. So he has right now, as he's sort of moving from the working years to retirement, he's doing the kind of thing that I was doing, and that is figuring out sort of the logistics of pulling money out of your your portfolio and how are you going to do that? And his specific question is this. He's got about, I guess it's almost 2 years of living expenses in cash. And his question was, should he incorporate that money in his overall asset allocation? Or should he take it out and just treat it separately and then do the asset allocation on its own? And it's an interesting question. I can tell you that in Bill Bingen's paper, who the father of the 4% rule, I'm pretty sure the way he did it was he took the money out and set it aside. Well, it was all theoretical, but pulled the money out, then rebalanced what was left in the portfolio. Now, in his case, in that paper, he was taking 1 year at a time. So he's taking 12 months. And so in that case, honestly, you could do it either way, and it probably wouldn't make that much of a difference. It's probably not going to change your portfolio that dramatically. And the other thing to keep in mind is if you're only taking, let's say, 12 months, a month later, you've only got 11 months, and it's going to dwindle relatively quickly. So if I were doing a year at a time, I probably wouldn't include it in my asset allocation, honestly, just for simplicity's sake. In this case, Phil's taking out more than that, almost 2 years. And so, I might include some or all of it in my asset allocation. Meaning, in my case, if you were 70-30 bonds, and he's got an allocation that includes 6% cash, and then he has 18% in a Vanguard bond fund. I'm looking at his portfolio, 11% in tips, and then the rest in stocks. So it's a 65-35 portfolio. Since he has a separate allocation for cash, I'd probably include it in the cash, but I don't know that I'd lose any sleep over the decision. And then the other thing I wouldn't do, though, is if I included it in cash, I wouldn't be like rebalancing every month, even if it's all in retirement accounts and there's no tax consequences. It's just too much of a hassle. So I probably wouldn't bother. I might rebalance. Well, I rebalance not based on time, but based on deviation, as we've talked about, opportunistic rebalancing. But I certainly wouldn't be rebalancing on a monthly basis. Even if you just did once a year, I think that would be perfectly fine. The other thing I'd probably do, and I don't have numbers here from his portfolio, just percentages, but I'd also just step back a minute and say, okay, how much of a difference does this make? If I include it in my allocation versus if I don't, and that's going to depend on how much money you have. If you have a lot of money relative to what you're spending, then your choice is probably not going to make much of a difference. Not much. So I would step back and just ask myself, how much does this really matter? And if it doesn't matter a lot, I'd probably do whatever's easiest, right? Yeah. So that's my take on it. Good question. All right, let's check out the stream again. By the way, I'd be curious what you think of this format. I mean, in previous live Q&As, I've had like a topic for the first 10 minutes, and I decided, let's just jump into the questions and including what's in my email. So Vino says, I am ranked number 288 on the Times of London crossword leaderboard. I nearly got to 200. Then I had a few errors. That's amazing. Crossword puzzles are not my friend. It's funny, I was an English major, but I think in numbers, not words. Frank wants to know, this is a question. What's the biggest investing mistake I've ever made? Well, not buying Bitcoin when it was 13 cents. No, that's actually not an investing mistake at all, actually. You have to assess your choices based on the information you had when you made them, right? There can be times when you make a terrible, if I go and play the lottery and I win, that doesn't make the decision to play the lottery smart. It's a dumb decision. I got lucky and I won. That's great, right? This is hypothetical. I didn't actually play the lottery and win. So you got to evaluate your decisions based on the information that you know. And so, when I look back, when I first started investing, I remember I went to a, what's the name of the bank? First Union? What was the name of that bank? They don't exist anymore. But generally buying an investment product through a bank is generally the first warning sign. But they put me into a front-loaded, high-expense mutual fund. But I don't know that I view that as my worst investing mistake. because I didn't know any better. I mean, I was making the best decision that I could at the time. And what was far more important was starting to invest. And I started to invest. That was far more important than understanding the fees and getting all of that correct. And so my biggest investing mistake. So I will say I don't think I've made any major mistakes in terms of investing. I mean, I've been mainly index fund investing for quite a long time. I do have some stocks, and they've just done really well. I did okay. Maybe I don't know if this would. I mean, there wasn't a lot of money involved. I'm almost embarrassed. This must be my biggest because I'm embarrassed to tell you what it was. When Netflix was just kicking Blockbuster's butt, I invested in Blockbuster thinking they could turn it around. That didn't work out. But I haven't, I haven't really had an investment where I've lost a lot of money. And even that one, I certainly lost some money, but it wasn't, I don't remember the amount, but a few $1,000. So I don't know that I've had like huge investing mistakes. Now I've had dumb spending mistakes. Like I joined a country club. That was stupid. I'm just not. I think I joined it because my father was big into golf. He died years ago, but he was big into golf, and I don't know. It seemed like I'm just not that. It's just not who I am. So I quit that, but it cost me some money because I only got half of my initiation fee back. So that wasn't an investing mistake. It was a pretty stupid. By the way, there's nothing wrong with joining a country club, and I'm sure many of you belong to country clubs, and if you love golf, then that's terrific. But it just wasn't my thing. So this is an interesting. I guess it's more of a comment than a question. And now I just lost it. Here we go. Mark says, "Are you aware that Portfolio Visualizer subtracts withdrawals at the end of the period? If you look at withdrawals on an annualized basis, you have to live your first year without money." I wasn't. So that's interesting. So, and if you guys are like wondering what's going on? I'll show you. So this is Portfolio Visualizer. We've looked at it many times. So sometimes we'll start with, let's just start with $1 million, and then we're going to withdraw a fixed amount. We'll say 40,000 a year. Annually, rebalance for inflation, and we'll just put it all in VTI. And Mark's point, if I understand it, is that, and this shows you, how you would have performed and whatnot. But his point is that this it actually gets withdrawn at the end of the first. It gets drawn every year, but at the end. And so, if you were modeling this, you'd live your first year without any income. Now, you could, I guess one way to deal with that is to say, well, we'll put 960 in here because assuming you had $1 million, you take 40 out your first year, and then you could even adjust this amount a little bit for inflation if you wanted, I suppose. But you could model it that way and then rerun the analysis. But I did not know that. So thanks, Mark. Actually, his next comment was basically what I just said. So look, great minds think alike, or we're both wrong. Okay. Joe has a riddler of a question here. Would you rather have $3 million and a $50,000 pension with a COLA, cost of living adjustment every year, or $2.1 million and two pensions for $90,000 and $40,000 pensions and two pensions for 90 and 40 with no COLA? I don't know. How would we even begin to think about that? So I'm giving up 900 grand. I'm getting 130,000 a year instead of 50, but it's not adjusted for inflation. So I'm getting an extra 80,000 for 900 grand. I mean, just off the top of my head, of course, part of it would depend on my age, my health. If one of these pensions belongs to my spouse, their health, but giving up 900 grand for an extra $80,000 a year that's not adjusted for. So if it were adjusted for inflation, just off the top of my head, I would probably take the pensions. That seems like a no-brainer because I'll recoup my money in 10 years, roughly. The trick is the no cost of living adjustment. That's the trick. But still, the other thing I would, of course, consider is, and I assume this is the case, but could you live off the 130? But at 3 million, you're only getting 120 roughly based on the 4% rule. So I think I'd be inclined to go with the pensions, but I'd have to think through that COLA issue. And what I would probably do is reach out to a financial advisor and see, let them run the numbers for me with different assumptions, or I could do it myself. But that's a tricky question. I think I'd probably go with the extra pensions. One of my hesitations is I really like controlling my own money. That's my bias. So Dave wants to know, what are your thoughts on long-term care insurance, which happens to be one of our email questions as well, that I already read, but didn't read the long-term care insurance part. So a couple of thoughts. So I've concluded that we don't need long-term care insurance. So the way long-term care insurance works is, of course, you pay a premium. The premium is going to depend on whether you're male or female. If you're married and you both buy it together, you can get some discounts. Obviously, it's going to depend on your age and your health. Of course, the younger you buy it, the less it costs. The older you are, the more it costs. All sort of obvious things. And this covers care. So if you needed someone to come into your home and help you, this is not medical insurance, right? You've got healthcare insurance for that. And healthcare insurance, by and large, doesn't cover this sort of thing. Now, I actually pulled up some articles that I want to show you on this very topic. Bear with me while I get to them. So what I did, I was doing some research on long-term care insurance. I came across, so NerdWallet, if you just Google, long-term care insurance, NerdWallet is usually the first result. The article is okay. It just lacks in a lot of details. But one of the things they do in that article is they have, I guess, an advertiser, and it's this ltcconsumer.com. Now, I know nothing about this company at all. So that's the first disclosure, but and I have no relationship with them at all. But I thought some of their information was kind of interesting. If you look at a couple of things about long-term care insurance. The first is the benefit is capped. There's a daily cap, there's an overall cap, and some of them, as you can see here, it's as low as, the total cap is 36,000. Now you can obviously go up higher, 600,000. But the price goes up, and I don't know. Let's see. They don't have the assumption on the age. Oh, here we go. Well, they say the average age is 56 for someone buying long-term care insurance. I don't know if these prices are based on that age or not, but obviously your age is going to have going to play a significant role in and how much it costs. But what I concluded was we could self-insure, given that the daily caps on most long-term care insurance policies. And again, that it's going to vary. And of course, the higher the potential payout, the more you're going to pay. And then there's overall caps that if my wife and I, if one of us or both of us needed it, we could pay it out of pocket, keeping in mind that there's also not just a cap on amounts, but time periods, like, 1 to 2 to 3 years. Again, it varies on the policy. In fact, if you come here, you can see right here, you can significantly change the cost of the policy by adjusting the duration of your benefits. And they talk about it as being as short as 1 to 2 years. And so when I sort of ran the numbers and thought, well, worst case, we need someone to come into the house, or I need to be in a facility. How much would it cost? And over what period of time could I reasonably get coverage? Could we handle that cost? For us, we could. So we don't have long-term care insurance. Now, I think it gets tricky because a lot of employers offer it, right? So when I look back on the different jobs I've had, there was long-term care insurance as part of my employment. So what most say, and in fact, I'll show you another, I'll drop all of these links below the video when the live stream's over. This is from AARP, They basically said that the sweet spot in terms of cost and whatnot to buy long-term care is between 60 and 65. Now, again, this is just one advisor that they quoted. You could talk to other people, you might get a different answer. But here was the thing that I was starting to think about. We know that if you wait too long, one, you might get denied. That's a possibility. And if you do get it, it can be very expensive if you wait like into your 70s and whatnot. But a lot of people that are still working might already have long-term care insurance through their employer. And so are you going to then, on top of that, buy it separately so that you have it when you retire, let's say at 65? You have all of these issues that you've got to sort of think through. When to buy it, the duration. In other words, if you need it, how long, what's your coverage period going to be? What's your daily benefit? What's your total maximum benefit? And you're going to find that the benefits are limited. And so you get this situation where if you really don't have a lot of money at all, you can rely on Medicaid, right? But of course, they're going to basically, as you probably know, take most of your assets. And there's ways around that, and you would need to talk to a financial planner or an attorney who specializes in all of that. If you have enough relative to your spending that you can self-insure, to sort of the opposite end, then you just don't need it. And that's kind of where we are. The tricky thing is if you're somewhere in the middle, where you certainly don't want to you don't want to have to give up all your assets if you need Medicaid, but maybe you don't feel comfortable enough self-insuring, but now you've got to spend this money to buy the premiums for something you may or may not need. I think it's a tricky thing, and everything I've read tells me that there's no easy answer. So. And I know I've just scratched the surface. I'll do a more detailed video with a lot of resources to give you probably next month. What I would do is talk to a financial advisor who's not selling me long-term care insurance. So in my case, I would talk to Mark Zorrell of Plan Vision if I were seriously considering long-term care insurance. The other thing I'll mention is that there are state partnerships. And they're hit or miss. I'll show you Virginia's. Let me see. Yeah. So here's Virginia's, a PDF from dss.virginia.gov. And there are some benefits in that if you later need Medicaid, you might not need to give away all of your money to get Medicaid if you've bought a long-term insurance policy that's part of these state partnerships. So what I would do is Google your state and long-term care insurance. The thing is you're going to have to do your homework. Like here, if you see here's Virginia's approved carriers. I can make this a little bigger. And that's fine. Okay, good. Well, let's just follow the link here. See, and it goes to a 404 page not found. It's like, thanks, Virginia. That's helpful. And so you're going to have to really dig. My understanding is if it's the premiums you pay could be deductible, but as you probably know, you need money on healthcare for it to be deductible relative to your income. So I know I've kind of jumped around with a lot of different issues, but to me, the big takeaways are it's expensive. The benefits, I think, are limited. When you buy is a big issue, the timing. If you wait too long, you may not get it, or it may be really expensive. Of course, who wants to start buying it at 50 and spending thousands of dollars on premiums every year for something you might never need, and if you do, you might not need it for 30 years, particularly if you have a job that gives you some sort of long-term care benefits. And then you have the whole partnership with the states that you need to consider. So it's a complicated issue, is what I'm saying. And those are sort of the things I would be thinking about. But I'll tell you what you probably won't find is some easy rule of thumb. Just, if you're this, and this, go buy it, and otherwise don't. It's just too complicated than that. I'm sorry. I wish I had an easy answer, but it's important. I will do more research and do a dedicated video to long-term care insurance. All right. This was an interesting question from a viewer named Frank. And Frank is basically in or near retirement. He did retire, and he and his wife have some money. And again, I'm sort of paraphrasing just to maintain anonymity. Has some money in, we'll call it savings accounts and checking accounts, right? And the questions were, can we put some of this money into our Roth accounts? And would we have to pay taxes on it? Should we even do this? Does it make any sense? All right. So first of all, if you're pulling money, first of all, can you contribute to a Roth IRA? Assuming you don't exceed the income limits, and based on the email, I don't think Frank does, but you got to make sure you don't exceed the income limits. I can pull those up, by the way. Just Google Roth IRA income limits. And what do we get? Here we go. Here's Schwab. I'm going to assume Schwab is correct. And there are the income limits. These are different than the contribution limits. You can see the contribution limits are here and here. But the income limits depend on your tax filing status, right? And it's based on your modified adjusted gross income. And for 2021, it's 140. I guess that would be for single person. Yeah, and if you're married filing jointly, it's 206 and 208 for 2021. So assuming, there's no income limits, you absolutely can contribute to a Roth IRA. There's no age restrictions. And there's actually, let me show you this. There used to be age restrictions on contributing to a traditional IRA. But as you can see here, this is the IRS website. I looked this up because I'd forgotten that they even did this. But for 2020 and later, there is no age limit on making regular contributions to traditional or Roth IRAs. All right, so we got that covered. Now, will there be taxes? And the answer, if you're pulling money out of a checking account or savings account, where you're already paying the taxes on any interest. This is not converting from a traditional IRA, let's say, to a Roth where there could be taxes, right? If there's gains there. If it's not a backdoor Roth, for example, contribution, then no, there shouldn't be any taxes, right? You're using after-tax money, and you're simply making a regular contribution. Now, keep in mind, you have to have income, right? Those limitations that I showed you here from Schwab assumes that you have income of this amount too. If you have zero income, then right, that would be a problem. But I'm going to assume you have the income. And then the final question really is, well, does it make sense? Let's say you're 60 or 65 or 70. Why contribute to a Roth? I think it makes perfect sense. I've often heard this argument that says, well, the value of a Roth depends on how long you're going to keep the money in there. But certainly if you can keep money in a Roth for a long period of time and it grows and you've got this massive amount of money that's tax-free, that's great, right? But you think about someone who's 60 and thinks, well, I'll hold on to this Roth. It'll be sort of the last thing I spend, and it'll be for maybe when I'm 80 and older. Well, they got 20 years to invest it. It could easily double twice in that time if it earns 7% a year on average. And so you're doubling it, and it's all tax-free. So I don't see why you wouldn't if you've got the money. Again, I'm assuming you don't need to spend this money. If you're going to spend this money this year or next, I don't know that it makes sense to put it in a Roth. Of course, you can always pull your Roth IRA contributions out, penalty and tax-free at any time. So I guess that's still, even shorter term is an option. The real question would be, how do you invest it? But if you don't, if you're willing to invest the money and you want to keep it long term, even at 65, you could be a long-term investor. You're not going to spend all your money in the first year of retirement. At least we hope not. I think a Roth is a great idea. All right. Tyler wants to know if I have any thoughts on AGNC. Well, I'm sure I do if I knew what AGNC was. Real Estate Investment Trust Company. Huh. So I guess it's a REIT. Yep, it's an internally managed real estate investment trust. So let me look it up in Morningstar. Maybe. Huh. Here we go. AGNC. There it is. So, big dividend, but of course it's a REIT, so that's not unusual. Price to book is interesting. I haven't thought about price to book in the context of a REIT. What that means is that the purchase price, you're getting more than the value, than the book value of the company. But you got to be careful on REITs because I don't know how they deal with depreciation and appreciation of property. By the way, if you could see them, I'm looking up, so I'm thinking in terms of book value. Anyway, back to Morningstar. We'll look at their trailing returns. Don't really have what we're going to do. We're going to put this thing in portfolio visualizer. AGNC. There it is. Of course, it's not going to outperform. Well, I wouldn't think. No, it's still done really well. This is from when? From January. Well, so it's done really well. I don't know how well you can see that, but 10.59% is the compound annual growth rate. Actually, just to be safe, let me get rid of these fixed contributions because that can foul the compound annual growth rate up. We'll put 100 grand in. So it has not outperformed the total market, but of course it serves a different purpose. You know, you get it out of diversity, and 12.58% is good, I think, for a REIT. But you have to keep in mind, I always step back and try to understand why. I mean, this is from January 2009, right? So you know that was sort of at the bottom when things were falling apart. So it's enjoyed some REITs generally in real estate have enjoyed a pretty good environment the last 10 years or so. I wonder how this compares to there we go, which is Realty Income Corporation. Yeah, Realty Income has outperformed it. Again, this now is from the same time period. 13.83% versus 12.58. I don't know in this case. Let me go back to what I don't know is how they're picking their investments. I also don't know what their fees are. I didn't see that in Morningstar, unless I just missed it. Don't know. Hang on for a second. I wonder if our friend Google tells us. They don't. That's interesting. I'll have to do more research on that one, Tyler. I just don't know enough to have an opinion. One of the best things you can say when someone asks you that your opinion on something is you don't know. I say that all the time. All right. By the way, a lot of conversations about the tax and unrealized gains. The one thing that concerns me too is right now it's for billionaires, but I mean, if it passed, I don't think it'll pass, but if it did, there were a lot of things. The income tax was for very wealthy people in the 1800s. All right, going back to email. So this was an interesting email for someone who's wants to retire in 25 years. The viewer's name is Claudius. They have a Roth IRA and a Roth 401k, and they have an HSA, and they have a cryptocurrency portfolio. I don't have any comments about their crypto portfolio because it's just not my thing, but I'll tell you what they've got. They got 30% in Bitcoin. This represents 10% of their portfolio is their crypto. And within that crypto portfolio, they got 30% in Bitcoin, 15% in Ethereum, 10% in Cardano, 10% in Polkadot, 10% in Polygon, 10% in Cosmos, 10% in Algorand, I guess I'm pronouncing that right, and 5% in Fetch. Yeah, I don't know. I don't really have a comment on that. That could be brilliant for all I know. But I do want to show you the portfolio. We're going to build it together. That's what I thought we'd do. So let me start from the beginning, walk through this. So I'm in Portfolio Visualizer. You got some options, a lot of options. I back test a portfolio. We're going to go to the Portfolio tab, and we're going to just put in the tickers, and we can look at them together. There's just a few of them. FXAIX, that's a Fidelity fund, right? Oh, that's just Fidelity 500. Good. That's an easy one to understand. 15%. PRGFX, this one I don't know. Oh, it's T. Rowe Price Growth. All right, good. And they've got 30%. And then TILIX, which is a TIAA fund, large cap. So a lot of growth. That's another large cap growth. 25%. And they've got another one. This looks like value. So this is kind of interesting already. It's like you've got 30% in a growth fund, another 25% in a growth fund. Then you've got 20% in a value fund. And these kind of end up, well, there's more in growth at the moment. We'll see what else you have. And this is a blend, right? S&P 500 is a blend. And I don't know how well you guys can see all this. I'll make it a little bigger. But they kind of wash together into kind of a blend portfolio with maybe a little bit of weighted towards growth. This is Vanguard, so mid cap, right? Fund, and that's 5%. And then small cap is 5%. And so let's analyze this first. So we can only go back to 2012. That's still a decade. And, compound annual growth rate of almost 17%, not bad. Now, the one question I have is, let's just do VTI. I always like to compare portfolios to very simple alternatives. And again, unfortunately, it's only 12%. I could substitute, you know what I'll do? I'm going to substitute this. I'm going to put in SPY because it's effectively the same thing. And it gives us more time. So yeah, it outperformed a little bit, 55 basis points. Now, that's total market. Now, if we put in, we'll have a third portfolio that's just S&P 500. Interesting. That surprises me. So the total market actually outperformed the S&P. I guess it kind of makes sense, maybe because of the time period we went through the Great Recession. But this portfolio, the one that Claudius emailed about, has done reasonably well. And he did mention expense ratios on the T. Rowe Price fund. I know I can find that somewhere here, but maybe not. This is just exposure. You can see that his portfolio has more exposure to growth. So my one concern, or not concern is maybe too strong, but I would wonder if it's benefited a lot from the fact that growth has outperformed value. And that's going to change. I don't know when, by the way, but it's definitely going to change. Yeah, the expense ratio on the T. Rowe Price fund is 64 basis points. But I mean, this tool accounts for that. And the portfolio has done reasonably well. I mean, we could compare it. We've compared it to the S&P 500. We've also compared it to total stock market. And it's compared well, probably because of its growth bent, would be my guess. So I guess the only thing I would say is when value starts to outperform growth, which will happen at some point, this portfolio might underperform a little bit, the S&P 500 or total market. But, this seems like a reasonable approach to me. Now, Claudius also had, let me show you this. He invests a portion of his portfolio in M1 Finance, and here we go. This is it. He shared this with me. This is one of the things I like about M1. I don't really do this, but you can have a very, very complicated portfolio, which is this certainly would qualify. But you can divide it into different slices. He's got 10 slices. that he names. And then within each slice, you can have all kinds of different investments. And then you can tell M1, all right, for each slice, I want a certain percent. Let me make this a little bigger, see if you can see it a little better. 28% goes to technology, 13 to healthcare, and so on. I'm guessing it looks like he's just divided among the 10 sectors for the most part. But if we drill down, like we'll just go into technology, you can see he's put in a number of companies. So within each slice, you can set the allocation. And then when you contribute money, it's up, you can set it to not do this, but it will automatically allocate any new contributions to bring you back in line with your allocation, right? So if we look at finance, it's interesting, the finance, because he's got financial companies in the technology portfolio too, like Visa, MasterCard, and PayPal. But fine, anyway. I'd be curious, there's no way for me to know this, how this is performed over the long term. It's got a dividend yield of 115, 51 holdings, and I kind of wonder if it's more or less tracked the S&P. Just a guess. But for me, my portfolio is only 4 companies. I just take the opposite. I take a focused investing approach with my stocks because there's just no way I could keep up with 51 companies. I barely keep up with the 4 I have. But in terms of the portfolio that we looked at a second ago, it seems fairly reasonable to me. I don't have a comment on the crypto portfolio. The stock portfolio, again, what I've seen, these are all pretty solid companies, but again, I didn't go in and evaluate 51 companies. The thing I would question is, are you really keeping track of these and analyzing them and listening to earnings reports and reading the 10Ks when they come out in the Qs? Probably not. Maybe he is, I don't know. And one could argue, if you're buying sort of blue chip companies, at the end of the day, this is such a diversified portfolio of businesses, probably be fine. Got energy. That's the nice thing about M1. You can have a really complicated portfolio and they make it very easy to manage. So I certainly, it would be hard to have this portfolio at a traditional broker. That would be tough. All right, back to the live stream. So Jack says, approaching my 3rd year in retirement, congratulations. In first 2 years, I pulled my payroll, puts that in quotes, from 401k once in January. I like this approach because I stress less. With market high, should I begin moving into it now or wait until January? That's a great question. If I were doing it, I'd take it out now. If I know I need my money for next year, I would take, well, with one caveat. The taxes, it's pulling it out this calendar year. How's that going to affect your taxes? So that would be a big consideration. I don't know if this is a Roth or not. So if it's a Roth, it doesn't matter. But if it's traditional, got to figure out the taxes. I wouldn't do anything before I figured out the tax consequences and if I was okay with whatever those are. But yeah, I probably would. And it's not, well, the argument against what I just said is I'm really kind of timing the market, right? Have a plan. If you're taking it out every January, just stick to it no matter what. And there's a lot to be said about that plan. So as I think about it, I don't know that I would actually. I might not. In my case, I would spend quarterly as dividends come in, but that's in a taxable account. So my situation is a little different. And I'm not pulling from a 401k yet. And I'm not old enough to without penalty, even though I got gray hair. I don't know that I would actually. I might just say no. It's more important that I not try to time the market. And if it means the market drops by 20% or 30%, then that's what it means. Also, if I'm rebalancing, I'm going to buy into stocks anyway, assuming bonds don't go down by a similar amount, which they unlikely that they would if we had a big stock market crash. So I don't know that I would. But we're already in October. At the end of the day, putting taxes aside, if it makes you feel comfortable and the taxes aren't a big deal, I think it, if it helps you sleep at night, why not? I guess you could tell I'm a bit ambivalent. Is that the right word? All right. So I don't know how helpful I've been on that question, Jack. I gave you an answer, then I changed my mind, and then I said it doesn't matter. Hey, you get what you pay for, which is, what can I tell you? I'm a guy on YouTube. I do think, in all seriousness, I do try to do things that avoid market timing and avoid my own emotions, avoid my own predictions about what things are going to do. And so if I were thinking in that vein, I would do whatever my plan was. And if that's take it out every January, I'd probably wait. That's what I would do. He does ask about LQDH. And I don't know what that is. iShares interest rate hedged corporate bond. So I can tell you already, this is too fancy for me. Doesn't mean it's not a good investment. I'm just saying it's too fancy for me. Expense ratio is 24 basis points, which, is not horrible. So they're hedging I've looked at LQDH before. And actually, I thought this wasn't a bad fund, if it's the one I'm thinking of. Its duration is like 0. We're going to see if I'm thinking about the right thing. Yeah, its duration is effectively 0. Look at this. The maturity, which is the average time when the bonds in this fund, weighted average, will mature, 14 years. So normally, for a fund like that, the actual duration is typically going to be less than the maturity. In a 0 coupon bond, they'd be identical, but for everything else, it'd be less. How much less depends on the maturity, the interest rate, and all these other factors, but it might be whatever, 10, let's just say. But here it's effectively 0 because they're hedging the interest rate risk. I don't know if they're I don't know what they're using to hedge. But in other words, they're protecting you against the risk of interest rates rising. Now, there's no free lunch, right? That hedging strategy is going to cost money. And you have to pay for it, right? They're going to, through expenses and whatnot. Now, remember, the expense ratio doesn't cover transaction costs. But going back to the fund, I thought its performance was actually, well, let's actually go back first to the quote page, because I think it was over 2%. 172. Oh, the current yield. So this is the last 30 days, 30-day period, right? Is 229. 12-month is 172. My initial reaction to this fund when I looked at it, I think I maybe discussed this fund in a previous video, was that's not a bad return or income for a fund that has effectively 0 interest rate risk. So if you go to the portfolio, then the question is, does it have credit risk? Meaning, is it investing in junk bonds? But it's not. It's not investing in AAA for the most part, but BBB is investment grade. And then if you go to the performance, we can see how it's done over the years. So, this is not a get-rich-quick fund for sure, but, I would start to compare this to other things with similar duration. So, like, if we go to, let me pull up Vanguard short-term bond ETF. What do we got? So, BSV. So if we come back here and we put in BSV, which is an ETF, there we go. It could actually have a longer duration. So its SEC yield is 68 basis points, 12 months is 132, so its return is not as good, or its current income, I should say. And it's got a longer duration, because they're not hedging anything. Now, it's a short-term bond fund. Now, the thing I don't know is, remember, and this is important, you earn money from a bond, bond fund, not just from interest, but also from capital gains, like if, for example, interest rates fall, which I know seems unlikely until it happens. And then if you're like me, you give up and say, I have no idea how all this works. But if we look at the performance, and we compare it to here, so year to date, they're at 252. The short-term Vanguard fund has lost 83 basis points. Last year, they were at 470. And so this one was 168. So in 2019, 951 versus 498. So I haven't dug into the details to understand like how these two funds are performing and why they're performing differently. I mean, they're obviously different funds, although they share some similar characteristics, kind of. But I kind of like the idea of having longer term bonds, but hedging the interest rate risk. It's just that I suspect over the long term, it's probably not giving us any advantage. That's my guess. But I guess time will tell. Hedging is expensive. Okay, several of you said you like this new format, so I am happy to hear that. What do you, what's this question? Sometimes the chat, it jumps down on me and I got to scroll back to where I was. What do you think of Bill Ackman's SPAC that is trying to bring Pornhub public? I didn't know that he was trying to do that. I don't know. Seems like an unnecessary financial shenanigans, but I don't know. Can you do a video to discuss the barbell withdrawal method? Sure. I think that's actually on my list, but I'm going to make a note. I will do a video. BCK something something says, I have maxed my 401k and Roth, I assume Roth IRA. So first of all, congrats. Thinking of opening a taxable consisting of 4 stocks. Okay. There was no question with that, but maybe, oh, here we go. Here are the stocks later down in the thread. Berkshire, Apple, PayPal, Microsoft. I own Berkshire and Apple. Microsoft is a fabulous company. PayPal is too. The one thing I don't know about PayPal is probably, well, they're all expensive, right? PayPal's, it's consensus forward PE. I'll show you here is 40. But I've got to believe that PayPal over the long term will do quite well. I'm trying to think if it's a fairly diversified, even with 4 companies. Apple, I mean, really, I kind of view Apple as a consumer product company, even though it falls in the technology space. Berkshire is insurance. Berkshire is a little bit of everything, right? Insurance, banking, it owns railroads, utilities, a candy company. It owns Dairy Queen. So what's not to love? That's actually interesting diversity between just 4 companies. I got no problems with those 4 companies. They're expensive now, but they're all expensive. What else we got? And I'm gonna go back to the email. What is the best growth ETF fund? Did I actually do an article on that for Forbes? I think I did. It may not be published yet, or I could be wrong. I did. Here we go. There it is. The best growth ETFs of 2021. I don't like that picture of me. I took that in the backyard of my old the house we lived in before our current house. I have a much better. I have to talk to them and get that changed. I don't remember what I picked. I think I remember this. I put the QQQ in there. I mean, how can you not put QQQ? It's just crushed everything for quite a while. So there you go. So just Google best growth ETFs, and Forbes Advisor will be somewhere on the first page. And I thought these were all good. Mainly index funds. Not completely. Well, yeah, QQQ, NASDAQ 100. There you go. All right. So this is not an email someone sent me. I'm setting up an Acorns account. You might be saying, Rob, what? So I want to test out a lot of these products. So I'm starting an Acorns account, and I think it'll probably be Acorns, but I'm going to keep it. And I'm going to add it to my credit card rewards. I'll keep it separate. My credit card rewards are in M1 Finance, and I'll keep a separate Acorns account. But the point is showing folks, investing relatively small amounts of money over time turns into piles of cash. And Acorns, as you may know, allows you to connect, let's say, a credit card. They will round up all of your purchases, sort of keep tabs of how much that roundup is. And then I think it's every $5 transfers it over and invest in an Acorns. One of the criticisms that I've seen is that are the fees. And I think it starts at like $1 a month, but if you don't have a lot of money in there and you convert it to an expense ratio, if you will, a percentage, it's high. And the thing that I think, and as you know, I don't like expenses. I want to keep my expenses low. And that was my first criticism of these sort of roundup apps, the fees. And then someone very close to me in their late teens, early 20s, one day, this was years ago, said to me, Rob, I've opened up an Acorns account. And I tell you, I couldn't be happier. I was thrilled. I knew that saving was not easy for them. This was a big step for them. The last thing I would say to that person, well, if you look at the fees, if you take that dollar and you divide it by blah, 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 that's an awful thing to say to particularly a younger person who's getting started. I love Acorns. Do it. Invest the roundups. At some point, might you transfer that to Fidelity or Schwab or Vanguard? Maybe. And yes, fees matter. As you know, I preach that all the time. But if that's your only takeaway, I mean, you have to recognize some people aren't comfortable with a 3-fund portfolio. I helped a family member set up a Roth IRA. They don't want to understand the difference between an index fund and an actively managed fund. They don't want to hear about a 3-fund portfolio. The only thing they want to rebalance are the tires on their car. All right. I get it. We set it up on Betterment. Yes, they're going to pay 25 basis points, and they won't even know it really. I mean, I explained all this, but it doesn't matter. They're doing the right thing. They're saving money, and I'm proud of them. All right. This comes from Kara. This was a great question. Kara says, from your perspective, what is the best way for a couple in their early 30s, with an average income, to build wealth and improve their standard of living? Should we focus on contributing as much as we can to our 401k and a Roth IRA? Should we try to get a rental property? Should we focus on getting promoted at work? All of the above. We don't have any debt other than the mortgage, but we feel torn between trying to get to a better spot in life as a young family while also making sure that we're saving enough for the future. Even though we consistently get raises, it feels like our money never goes quite as far as we'd like it to. That's a wonderful question. And here's how I think through it. So as a starting point, you're making whatever you're making right now. And obviously, the less you spend, the more you can save. The more you can save, the more wealth you'll build and the faster you'll build it. The trick, of course, and you allude to it, is there's this tension between wanting to enjoy life now versus maybe enjoying life later, right? And it reminds me of a question, I'll say a family member asked me once when we were talking about saving. They said, well, what am I saving for? You tell me to save 10% of my paycheck or 20%. What am I saving for? And I didn't really have a good answer to that question because this wasn't a retirement question. You're saving for retirement, and what 20-year-old wants to hear that anyway? And later I got the answer. It's why I end every show the same way. The best thing money can buy is financial freedom. What you're buying, what you're saving for is your independence. Forget retirement for the moment. Forget 65. You're trying to buy your independence. And it's not as if you have no independence, none, and then you hit some magic threshold, $1 million, 100,000, whatever. And now all of a sudden you have independence. It's gradual. Every dollar you save gives you a little bit more independence. But that's how I viewed it. That's what I was buying. I wasn't saving so that I could live some certain lifestyle. It was, I saw it as buying my independence. And I can go out to eat 5 days a week, or I can go out 1 day a week and use the rest to buy my independence. And the trick was, how can you live happy wherever you are? And what do you need to be happy? And, I look around at all the toys I have and I think, well, Rob, you apparently need a lot to be happy. Yes and no, I suppose. But I kind of concluded that if I can be genuinely content in life with less relative to my income, that's a good place to be. And how can I try to make that happen? So we went without a second car, which may not seem like a big deal, I suppose. They're first world problems, right? And I was completely happy. I walked a lot. Now we've ended up getting a second car because of our grandchild. But you have to make these decisions for yourself. But the starting point is to figure out how you can be content on as little as possible. Now, I'm not talking about, reusing your Ziploc sandwich bags. By the way, if you do that, that's fine. But I'm not here to tell you to live. I'm not talking about that level of frugality, but just generally, how can you live on the least amount and still be content? Part of that is a learning process. The whole car thing was sort of a what if challenge for me. Well, what if I got rid of our car, our second car? And my wife was not a fan of it. She goes, this isn't going to last. Part of me agreed with her. And I thought, well, if it doesn't last, I'll get another car, right? You could just park your second car. Just, you don't have to sell it. Just don't drive it for 2 weeks. What happens? The point is, I kind of went through some of these experiments and we reduced our spending significantly. But back to our specific question, but that's really fundamental, because what I hear in this question is this tension between enjoying today and saving for tomorrow. I view it as enjoying today versus buying my independence, which is different than saving for tomorrow. Maybe it's just a frame of mind, but I think it's an important one. This isn't saving so that I can live when I retire, although that's certainly part of it. It's buying my independence. In terms of what you should do, obviously maxing out retirement accounts is important. Sounds like you're doing that, or you're contributing as much as you can. Rental properties, and I've owned rental properties before. The thing to keep in mind is it's a lot of work. I think it's a great way to build wealth. If I were coming out of high school and I wasn't going to go to college, and maybe I wasn't going to make an above average income, I think real estate would be a big part of what I did. I might start off house hacking, where I rent out a room, or get to a point where I have a duplex and rent out half of it. Now that may not work for your situation, but rental properties, it's a job. It's not passive. Now you can hire out management, but even then there's some level of work on your part, and you're giving away a lot of your profits to the management company. So I personally wouldn't be quick to jump into rental properties unless you really enjoy that work, because it's a job. What I would do though, and this is tough, but I think everyone should have a side gig. And I think given all of the different ways you can make money online, whether it's a YouTube channel, blogging, writing. I know people that write for other sites and make 6 figures a year. You don't have to go crazy. You've got jobs and you've got a family, and so you're busy. I started my first blog, which I've sold, but it was doorroller.net, as a part-time hobby in 2007. It turned into a full-time business. And it was work. I was up at 5 a.m. every day when I started at 5 to 7, worked on it, and then went to work. But it was life-changing. The thing about a side hustle is the money that comes in, even if it's relatively little, we psychologically, we treat it differently. It's just different. It's easy to save it or apply it to debt. It's like, okay, we've got our budget, our day jobs, and that's all there. And now we've got $200 a month coming in as a side income, or 500 or 1,000. I've got friends who actually invented a board game for children, and it ended up doing okay. But they did the whole thing. They had it designed. They built in China, shipped over here. They had like 5,000 of them stored in a warehouse, trying to sell them, and they had a website with it. And they started adding content to this website. Well, they don't sell the games anymore. They sold their inventory and they're done. But their website makes a decent amount of money every single month, and it's done that now for years. I mean, really, the ways you can make side income online are just limitless. And it worked for me. It was the approach I used. But by the way, I'd be curious in the chat, or you can email me if you'd like. There's been part of me that's thought, should I do a separate channel on how to make money online? The problem is, it's like I've only got so much time in the day. So then part of me thought, well, I'll start a separate YouTube channel. Every video will just be live streamed. If I'm going to sit down and work on one of my websites, I'll just turn on the live stream, start talking to the 3 people that show up and showing you my screen, and I'm blogging, I'm in WordPress, I'm doing keyword research, I'm trying to figure out topics that are important to people and how to write the best article on that topic, or I'm thinking about YouTube, and I don't really do a whole lot with YouTube in the sense of trying to game the system. I don't even do thumbnails anymore. Usually my thumbnail is a picture of me doing that. But in any event, I don't know. I obviously I haven't done that. Be curious. I don't know. I don't think this channel makes much sense. This is retirement and investing. But Kara, to answer your question, I think side income goes a long way. And it could change your life. I can't tell you the conferences I go to, the friends that I've met that I now have known for over a decade. I have a mastermind group, about 12 of us get together once a year. They're great friends. Many of them have sold their sites. It's been life-changing. I don't know how well I've answered your question. Hopefully some of that helps. I definitely agree with all of the above, with the exception of rental property. That you need to think through carefully. That's a lot of work. It can be a great way to make money, but it's a lot of work. All right. So one person wrote in, I can't pronounce their name, but they were asking me about 403Bs and if I have any experience with them, because a lot of times they include insurance products that are expensive. My wife had a 403B because she worked at a nonprofit. She had some basic mutual fund investing options, so it's kind of no big deal. But I know that some 403Bs can be not so great. One of the points that they make in their email is some of them allow you to do a self-directed. So Fidelity has this for their 401ks, and I take advantage of it. You can go self-directed and invest in pretty much anything you want. So if you have a 403B and the investment options are not good, see if there's a self-directed option. The other thing I wanted to mention, I didn't have a whole lot that I could help with this particular question because I just don't have a lot of experience with 403Bs. And as I said, the limited experience I have, it was not bad. But they did mention a resource to me, and I want to share it with you, 403bwise.org. I don't know if this will be helpful to you. I've not spent any time on this website, but it's .org, so it's got to be good, right? That was a joke, not a good one. Anyway, if you got a 403B and you're not happy with it, maybe the resources on this site could be of help to you. So there you go, 403bwise.org. Just passing it along. All right. So this was a great question from a listener viewer named John. He's really kind of struggling with, he even called it analysis by paralysis. He's got a lot of mutual funds and he's trying to whittle them down. And I think these are all in retirement accounts. But here's his struggle. He's got an S&P 500 fund and he's got total stock market funds. And he can't, his struggle is he wants one or the other. He doesn't know which one. He's watched my video that I did on VTI versus VOO, VOO. That's Vanguard's total stock market versus their S&P 500 index fund. And I just showed that over time, and we can look at it again. If we, let me go to Portfolio Visualizer real quick. And if we do VTI at 100% versus VOO, whoops, at 100%, I don't know how far back this goes, 2011, they're neck and neck, right? He knows that, but he's still struggling. Does he go with VTI or does he do S&P 500 with maybe some mid and small cap? He's got 65% stocks, 35% bond portfolio, which is, I think, reasonable for retirement. And so here's my take on it. I think there's fundamentally very little difference between, say, VTI on the one hand and an S&P 500 with mid and small cap in separate funds on the other. And in fact, let me just go back to Portfolio Visualizer. Whoops. Here we go. We can look at this from an asset class perspective. Total stock market, 100. Of course, watch this. This will show a really big difference. Mid cap and small cap. Now the trick here is how much to put in. I'll just do 80, 10, and 10. Yeah. So in this case, this is going back to 1972. The S&P 500 with mid and small cap outperformed. It's not by as much as you think. I mean, obviously, this is looking at what, 50 years. But in terms of the compound annual growth rate, it's only 26 basis points. I say only. Obviously, over 50 years, that matters. But we could add contributions, and that might change it. And we could change the percentages we've got for mid and small cap, and that might change it. Effectively, the difference between these two portfolios is that portfolio number 2 has a greater allocation to small and mid cap than this one does. This is U.S. markets, which is total U.S. market. So it has small and medium-sized companies, but probably not at the 10% level. In fact, if we go to Morningstar and we look at VTI, which is a total stock market index fund, and we go to portfolio, and then we want to do weights right here. I don't know how well you can see that. So it's got actually more than 10% in the mid cap, right? 18%, but less than 10% in the small cap. So if we go back to here, we're sort of overweighting small cap and underweighting mid cap a little bit. But again, you could change these percentages. At the end of the day, I think you're likely to come up with similar results. The question becomes, what's more comfortable for you? If you go with this approach, S&P 500 plus mid and small cap, it's obviously more work. You've got 2 extra funds. You've got to rebalance. And so you got to factor that in. And so the question, I suspect, and this is just my own guess, that John senses that an S&P 500 with mid and small cap might over a period of time outperform, and maybe he's concerned about losing that outperformance. Of course, the truth is, 1, we don't know if that will be true, and 2, a lot of it will depend on how much you allocate to mid and small, and that's the tricky part. So if you can allocate to mid and small and keep it and stick with it and not change it, it's a perfectly reasonable approach. But if you think, well, we'll allocate to small, but then small doesn't do well, so then you lighten the load, and then it does really well for a couple of years, so you add more to it. That's like the worst thing you can do. Okay, well, it's not the worst thing you can do, but I don't think it's not a sound way to invest, in my view. I've mentioned this before. You can lose a lot of money jumping from one reasonable allocation to another. So if that's going to be a problem for you, personally, I would just go with one fund. If you think you can allocate a set percent to those other asset classes, rebalance whatever once a year, for example, and never change it, I think it's a reasonable approach. The analysis by paralysis, the thing that I would tell myself is that at the end of the day, there's no way for me to know which one will do better long term. There's just not. So I just have to pick one. I think that kind of helps. Maybe not. All right. I go away from the live stream and the chat to answer the emails, and then I think to myself, maybe everyone's signed off and there's absolutely no one watching. So when I come back to the chat and you're still there, I'm kind of happy. Mark wants to know, what causes a fund with a low turnover rate to have high potential cap gains exposure? Example, SWTSX turnover is 4%, but old Morningstar tax website says capital gains of 42.3. Well, that's a great question. And it actually is kind of one that someone else asked me in the emails about taxes. And I promised to answer it. Came from Jim. Basically the same issue is that there are certain funds where they have end of year capital gains, even they get distributed to you, even if you didn't sell. So we all understand capital gains if we sell an investment at a gain. That's easy, right? But you can own a mutual fund. ETFs, I think, have more or less solved this problem, maybe. Although Jim mentions an ETF where that may not be the case. And we'll look at it in a second. But there can be situations where the fund distributes capital gains to you that you have to pay that year. It's taxable income, even though you never sold a share. And so the trick is, or the problem is, let's say you dump a bunch of money in a mutual fund in November. They not always, but they often distribute these capital gains in December. You could get hit with a capital gains distribution the next month. You're like, what happened? I haven't even sold anything. I just invested. I barely had time for a cup of coffee. Now I'm paying capital gains. What's going on? All right, so we'll look at it. I'm going to go back to Morningstar. Let's see. I may have one of these pulled up already. So first of all, some history. Believe it or not, let me come back here. Let me look you in the eye on this one. Vanguard figured out a way to avoid distributing capital gains on mutual funds. It's easier with ETFs, but with mutual funds, it was tricky. And they figured out a way to do it, and then they patented it, which I've had a couple patent litigation cases, although I'm no patent expert. It's kind of odd to me that they can patent this. And there's part of me that's a little upset with Vanguard. It's like, really? You want to keep, I get that there's competition, but this could help people. So why are you patenting it? And maybe I'm just naive. Anyway, they did. And in fact, there's a good article on this right here on Bloomberg. So I think I Googled, how does Vanguard mutual funds not pay capital gains tax or something like that? And they talk about this whole thing that they did and how they did it. And the key, though, is that for a lot of Vanguard index funds, these are the ones I've been invested in, I haven't paid any, they've not distributed any capital gains, and for as long as I can remember. So this is an ETF, and so is this. So let's go to VTSAX. This is a mutual fund. I'm going to show you where you can do this with any investment, any fund. You want to go to, no, I don't remember. I think it's price. Is it price? Not price, it's performance. You want to go to performance. I think, yes. And then you want to click this little button here that says distributions. And it shows you the distributions the fund has made. So of course it has income, which is dividends, right? Every year. In fact, 4 times a year. But look at this, short-term capital gains, nothing. Long-term capital gains, nothing. And if we go to like, is that the right ticker for their emerging market? Yes, check their emerging market. Watch, this one will have capital gains taxes distributed, at which point I just give up. No, I'm pretty sure it doesn't. Distributions, yeah, see, nothing. I don't know how well you can see that, but these 2 columns are short-term and long-term capital gains. They've distributed nothing. And we could go back, I don't know, on Morningstar, but they haven't distributed gains in a really, really long time. Now, let's look at a different fund. This is one I invested in a long, long time ago. It's a good fund, Dodge & Cox. Dodge & Cox generally has good funds. It's actively managed, so it's 52 basis points. I invested in this, as I said, years ago. It's sort of a value fund, and it's a large value fund. But if we go to performance, check this out. Now this is actively managed. That influences it. Go to distributions. Look at these distributions. Last year, $8 a share, long term. That's 5%. Well, roughly. The year before, they distributed $10. And actually, in 2020, 8 was just once. They distributed $1.75 in March. So, and this is distributed as long-term capital gains. So, it's good that it's long-term capital gains, although you can see they've got some, it's small, but they have some short-term capital gains. So you need to, if you're investing, well, I probably wouldn't invest in this fund in a taxable account, but if you were, this is something you need to consider. Now, and that's where you go to find it, right? Let me go over to quote for a second. I'm going to look up the fund that was mentioned in the chat in a second. Turnover here is 21%. The turnover, which represents the percentage of assets that get bought and sold every year. The fund that Mark mentions in the chat, let's look it up. Is this a Schwab fund? Oh, it's just their total stock market index fund. By the way, the patent that Vanguard has, I think, expires in 23. Oops, yeah, performance, that's what we want. We go to distributions. Yeah, so it's just, look at this. They've distributed both short and long-term capital gains. It's not huge. If you look at long-term this was December, well, let's go to December 2019. Looks like they didn't distribute anything in 2020, but that's probably, I'm guessing, because of the COVID drop and they were able to manage everything. But it's 13 cents a share on a $55 NAV price at the time of the distribution. It's peanuts, but it's something, right? Obviously, it doesn't compare to Dodge and Cox. Now, in the chat, Mark mentioned that its turnover is just 4%. Well, it's still turnover, right? And it also matters what they're selling and what the gains were when they sold. That's one of the problems with mutual funds in theory, is that if a lot of folks, get scared, maybe start to have a bad market. Of course, if it goes down, they can maybe manage the gains, but they start to sell their shares. They're selling them back to the mutual fund company. Exchange traded funds get traded between investors, just like stocks do. But with mutual fund shares, I'm not selling them to another investor. I'm selling them back to Vanguard or Fidelity or Schwab. And to pay for those redemptions, they may have to sell investments in the fund, which could trigger capital gains. Now, the turnover rate of 4% is low. I agree, Mark. And maybe that explains why the gains they're distributing are relatively small when compared to the NAV, which is what you want to compare it to. But they're still there. So it'd be interesting to see if that changes. I looked at a couple of Fidelity funds. I think their total market fund, and they didn't have any gains distributed since 2019. In any event, you can put the ticker into Morningstar and follow what I just did. And there's another one in the email from Jim. He mentioned IVV. Let's check that out. This is just an S&P. Yes, an iShares S&P 500. Let's go to performance, distributions. Yes, I'm not sure. This hasn't had any. Yeah, I see. He was guessing it has little, if any, capital gains. It hasn't distributed capital gains since 2019 anyway. So, but if you're going to invest in an actively managed mutual fund, even an index fund, but where it can really be an issue is an actively managed fund, even like Dodge and Cox, where I think by and large is a good fund, it may not be smart to hold it in a taxable account. All right. Great question. Vinyl asks, what is the sweet spot in retirement income not to buy long-term care insurance? That's the thing, the rule of thumb. I'll research if I can find a rule of thumb. I haven't been able to find one. And frankly, the content that I found online has not been great. I'll work on that. All right, I'm almost through with my email, and then it'll all be the chat. Oh, this is a good one from a listener named Jerry. A good one in the sense this is tricky. So here's the deal. He called it a fixed annuity. It sounds to me like a variable annuity, but in any event, he put some money, about a third of retirement, in an annuity. It sounds like it tracks the S&P 500. And the deal is, if the S&P 500 goes down in a given year, he won't lose any money. So zero's the floor. This is not uncommon. That's really the selling point of a lot of these products. You can't lose money. No, there's no free lunch. So what's he have to pay for that? Well, among other things, if it goes up, he gets a share of that. And there's two ways. There may be others, but two that I know of that this works. They can either cap what you get. So they'll say, okay, you'll get anything up to 10 or 12% if the S&P 500 goes up, but anything above that, you don't get. Or they'll say, look, you get a benefit no matter how much it goes up, but you're going to have a participation rate. So you'll get 80% of so if it goes up by 30%, that's great for you, but you're only going to get 80% of that gain, and the insurance company keeps the rest. But they can't put a floor on what you can lose without also putting a cap on what you can gain, or they would go, they wouldn't survive. But here's the thing. He wants out now. He just bought this a few months ago. The problem is, this is just one of the many problems with an annuity, there's penalty. And if, let's see, it's a 10-year term with penalty for cancellation of 10% the first year. So he'd lose 10% if he got out of the annuity today. That percent goes down every year by 1%. And then after 10 years, you can You can cancel it with no penalty. You can also take, if I understand his email correctly, you can pull out 10% a year, up to 10% a year without penalty. So he could take out 10% this year, 10% the next. He wants to get out. What should he do? So the first thing is, number one, I would talk to an advisor, not the person who sold you this thing, but an advisor who's got no interest in this. I don't know what the tax implications are of selling. There may be none. I don't know. But that would be my question one. What are the tax implications? I would be, personally, if I were in this situation, I really don't like the idea of giving away 10% of my money, even to get out of an annuity. The other thing is that there is downside protection. And I think, over the next 10 years, we're going to have some ugly markets. I don't know when, I don't know how long they'll last, but there could be some benefit, right? Now, again, there's no way to know it. I could be wrong. Who knows what the future is going to hold? But it's kind of hard to see the next 10 years being like the last 10 in terms of the market. If I were in that situation, subject to talking to an advisor, I would be inclined to take 10% out a year without penalty. That would probably be my inclination. Maybe as I got closer and the penalty went down, might I take it all at some point rather than waiting the 10 years? I might. But I personally, losing 10%, that's a high hurdle for me. I would, even given that it's an annuity, plus if you paid any fees when you bought it, I'm assuming those fees you don't get back. I don't know what the ongoing fees are, but that's probably what I would do. But I would talk to a financial advisor first before I made a decision. I want to understand the tax consequences of any of my decision and get their thoughts on it and be able to have a dialogue back and forth, because this is one of those situations where there's just no one clear answer in my mind. Tough situation. I'm sorry you're in it. Yeah, that's just one of the many problems with annuities. All right. This question comes from Saeed, and he gave me his portfolio. It's basically 50% total stock market, 20% small cap value, 15% international small cap value, and 15% emerging markets. The portfolio in and of itself seems reasonable to me. But the real interesting thing here are the funds. And I'm going to show you, we're going to put this portfolio together very quickly. The total stock market is just VTI. But he uses Avantis funds, which I had not heard of. For the other three, 20% here. They haven't been around long, so we're not going to get a lot of data. I'll just tell you that right now. I think they started in 2019 or something around there. And emerging markets, 15%. Yeah, so they started in 2019. So we've only got a year and a half worth of data. And we could compare this. Oh, let's just compare it to we'll compare it to a 3 fund. But since he's all stock, I'll take this 20% out and I'll put, we'll just do the same. He's 70-30. So we'll just do US 70-30. And actually his portfolio, again, it's only a year and a half. So what do we do with that? It's life. It's actually outperformed a little bit, 18.47 versus 17.54. It is riskier. Its drawdown has been higher even in this short period, 28%. But it's done reasonably well. When I looked up Avantis, and we can put some of these, let's see, AVUV, they look like index funds with a twist. I think there's 25 basis points. Yeah. So that's not an actively managed fund, but if you look at their portfolio, and this is small cap and it's value. So you're making a bet on value. That's personally how I invest, even though growth has outperformed value over the last decade. So I'm a big fan of value investing. Look, you got a forward PE of under 10, price to book of just over 1. I mean, this is truly a very small. In fact, we can look at its average market cap here, just 2.6 billion, small by publicly traded company standards. This looks like a reasonable fund to me. We can look at its holdings, but since it's a small cap, it's probably not going to mean much to most of us, myself included. Obviously, we've all heard of Goodyear and AutoNation and Macy's, but there are going to be a lot of fund companies in here that we've probably never heard of. But this looks like a reasonable fund. It just doesn't have much history, so there's just no way to know. And so if you go to performance, for example, it's going to have what? 2020 and then this year. Let's look at distributions. What did it distribute in 2020? Okay, no short-term or long-term gains. That's good. Let's look at one more. We'll look at emerging markets. Got to be a higher expense ratio. Yeah, but still reasonable, 33. Obviously, you can get cheaper than that, right? Vanguard, Fidelity, they're going to have cheaper. If we we'll look at the portfolio. This is not a value. Well, it is a value fund, just close to blend. It's obviously larger companies, but still a forward price to earning that's under 10. So if we rotate from growth to value, these funds should do well, I would think. Let's look at its distribution since we've been talking about that today. So at least in its short time, it hasn't distributed anything. So that's good. Again, you got to give it more time. 2020 should have been a reasonably easy year for funds to avoid, although they didn't all avoid it. We looked at Dodge and Cox. But these, they look like reasonable funds. I guess one question is how you found them and why you're using them, given their relatively short, time frame. But they look reasonable to me. The expense ratios, you can get cheaper, but they're still, I think reasonably priced. They are, one thing that I'll say, and I'm reading from the websites for these funds, designed to increase expected returns by investing in U.S. small cap companies trading at low valuations. The one thing you could look at is how they're defining that, and what they use to determine valuation. But it's probably going to be some combination of price to earnings and price to book, maybe price to sales, that sort of thing. But even with that information, they're basically, the U.S. funds are all three of them, they're value funds. So you're making a bet on value. I don't think it's an unreasonable bet. Over the last 10 years, it wouldn't have worked out well. But I think long-term value is a good way to go. So finally, and on the email front, and then I'll turn back to the chat if anyone is, still watching. It's going to take me forever to put the timestamps in this thing. Stephen emailed me and wants to know, we talked about this a little bit, but Vanguard ETFs versus regular mutual funds. In your opinion, is there much of a difference between the two? I generally hear people using them in their portfolios, meaning ETFs. We use Admiral shares. We just looked at this, right? On the tax front. For Vanguard, no, there's not much difference. If you're at Vanguard, you can invest in either for free. If you're at a different brokerage, investing in the mutual funds may cost you some money. And so for that reason, you might pick the ETF, and that's fine. If you're on a platform, Betterment and Wealthfront and SoFi and other robo-advisors are going to use ETFs. If you're on M1 Finance, it's going to be ETFs. That's fine. But if you're at Vanguard and you use their Admiral shares, I think it's great. And I got an inbox 0. That's even better. Well, maybe not, but it's still nice. Deuce wants to know, how do you feel about REITs in a portfolio? I like them. I have 10% of my portfolio's REITs. I think it gives you diversity. You get exposure to REITs in an S&P 500, about 2.5%, I think, of the S&P 500 is in REITs. Same would be true with, say, a total stock market. So you don't have to actually have a REIT fund to have exposure to REITs. But I like to have a little extra exposure. So that's been part of my 6-fund portfolio, right? Got to say, you got maybe an S&P 500, a small cap fund, or maybe small cap value, developed country international fund, emerging markets, REITs. I've got one more finger, bonds. Yeah, that's kind of how I've done. Now, sometimes with the bonds, I'll split into treasuries and tips. I like having some REIT exposure. I just use a Vanguard REIT index fund. I hear you, Salty, on the both short and long term. Fair enough. I'll even make a note. Short term. I really don't feel a need for short term, but that's a whole nother video. James wants to know, what do you think about dollar cost averaging into a basket of stocks that you think will outperform long term for a small portion of your portfolio? I think it's a great idea. I think for the vast majority of investors, index funds, low cost index funds should be the core. But that's effectively, I didn't really dollar cost average in my case. I just invested lump sums at various times. But, and you know, so far, knock on wood, the stocks have done much better than the index funds for me. Is it luck? Well, I don't know. In 30 years, I'll let you know. But yeah, I think it's great. I enjoy it. Let's see, we can even, while I'm going to the next question, I'll sign in to M1 Finance. This is just a small portion of our stock portfolio, but I take all our credit card rewards and I invest it in M1 Finance, and I'll show you how that portfolio is doing. Hang on, I got to use my two-factor authentication. I hope you have two-factor authentication set up on all of your financial accounts and email. Frankly, email, critical. All right, how am I doing? We got $32,461.63. This is my credit card rewards portfolio. And I've got a penny for cash. I got that going for me. These are my gains since I moved it over to M1. I had gains before I moved it. And it's just two, right now it's just two. My pie is simple. Bank of America and Wells Fargo. They sort of epitomize how I invest. It wasn't some brilliant analysis. It was, these are both low values. They were both trading under book value, not uncommon for some banks. Citibank is under book value right now. They're now both above book value, I'm pretty sure. Book value is particularly important metric for banks. Well, Bank of America is well above book value, I can tell you that, but we'll take a quick look. Price to book, yeah, 156. And I'm sorry if that was too fast. Let me slow down. Right down here, price to book. And Wells Fargo is going to be, like my Bank of America stock has doubled. I bought it last October, it's doubled. Yeah, they were below book value as well when I bought them in January, I think. And they're now slightly over. But like if you go to like Chase, is this Chase? Yeah, JPM. I don't own Chase directly, but they're going to be well above book value. Yeah, 194. But if you look at like Citi, by the way, this in and of itself doesn't make it a good investment. I've always been well, let's just see, and then, yeah. Citibank is a complicated, it's, you know, not all banks are created equal. Citibank is an immensely complex company to analyze. So I don't try. I like easy investments, but their price to book is 0.76. So many have said and believe that this is a great investment. I don't own shares of Citi. I'm not recommending it one way or another. But if it's certainly a value play, no question about that. So anyway, yeah, I like taking a small portion if that's what you want to do and putting it in stocks. Alex says, VONG is the Russell 1000 growth index. Is it better than the S&P 500? No, it's not better. It's different. It's like saying, is soccer better than, I was going to say football, but depending on where you live, that could be a confusing question. And I'm guessing it was probably a dumb question because probably everyone listening has a very strong opinion on that question. All right, I'll make it easier. Is Coke better than Pepsi? Nah, probably not a good. Pepsi, by the way, is what's better. But in any event, I'm from Ohio. We call it pop. I mean, they're just different investments, right? I mean, we can look at it. So we can put VONG. And we'll put in an S&P. We'll just use SPY. So this is the 1000. And if we go to the portfolio, we're going to see that it's going to be on the growth side of things, super growth, super big and super growth, right? Whereas the spider, and since the first one's a Vanguard fund, I'll actually use VU instead. It doesn't really matter, but it's a Vanguard fund. And we'll go to portfolio, and it's going to be closer. Yeah, it's a tad smaller. And we can actually see that if we go to market cap, 202 billion versus 291. But where the big difference is when you come down here and we compare the two. So this is the Russell, and this is an S&P, right? And we look at the portfolio. They have similar companies, but like Apple's got 6% versus 10. I mean, the first two companies are 20% of the portfolio. And so, it's got a similar number of holdings, but it's heavily weighted. So these are very different. I mean, they may not seem that different, but they are. Like lightning and lightning bugs. They may seem similar, but they ain't. And so I don't even need to look this up on Portfolio Visualizer. There's no doubt in my mind that this fund has outperformed because growth has outperformed. So I got to look it up. We'll start from scratch. We'll go to portfolio. We'll go to, there we go. We'll compare it to VU. Whoops. There we are. And how far back does this go? Whoops. 2011, perfect. So the Russell has to have outperformed, right? Yeah. Because growth has outperformed. Interest rates start to go up, we rotate back to value, the S&P 500 will outperform. And for that matter, value funds will outperform the S&P 500. That's just, it goes back and forth. Again, I'll stress the big thing is pick something that you can stick with. All right. I got a lot of catching up to do in the chat. Please comment. This is from Frank. Please comment on October 14th Forbes article referencing a Dartmouth College paper that says the U.S. economy is already in recession. I don't know what that article is. I don't think I wrote it. I've heard this idea that we're already in recession, but I'll have to look that article up. Dartmouth. Recession. Please compare BND versus SPHIX and VWEAX, short-term junk. Higher yield and lower duration covers higher quality risk, in my humble opinion, at this point of time of low yields. Thoughts? Well, we know what BND is. That's an intermediate term Vanguard bond fund that invests in government bonds, corporate bonds, and real estate backed, mortgage backed securities. So we know what that is. I don't know what SPHIX is. Oh, Fidelity High Income. All right. Going to go to portfolio. By the way, my analysis of these, the pattern is the same, right? And we're doing sort of the same thing. So this fund certainly has less interest rate risk than BND, because if we go to BND, its duration is like 7, I think. Yeah, 6.8. This one, it's interesting, it doesn't have an effective duration, but it has a modified duration. I don't know what that's about, but I'll just assume 3.36. So its interest rate risk isn't as great, but you're taking more credit risk, meaning risk of default, and you see that down here. This is a junk bond fund, which is not a bad thing, by the way. We call it junk bond. High yield is probably maybe the better way to think about it. But anything below BBB, so down here, I don't know how well you can see that on the screen, but that would be junk bond. So again, it's kind of like, you can compare them, but they're two totally different investments with two totally different risk profiles. it's got a nice 12-month yield, that's for sure. I don't know but the thing is, you can't just look at yield, because performance is a combination of yield and capital gains or losses. So if we look at performance, and again, we're really comparing apples to oranges here. But who cares? So B&D has lost a $1.65, and this is up 3%. The shorter term high yield fund. Last year it was up 244. B&D was up 771. The year before that it was up 884. This one was up 14. So, we could put these in portfolio visualizer and look at them long term. They're both, they're both, obviously they're both bond funds. I generally don't invest in high yield because it's not really what I want to do with my bond fund. I'm sort of reevaluating all of that. I'm looking at commodities, which I don't really invest in directly. I'm looking at high yield, but I haven't made any changes, and I can look at it for months or years without making changes. But the reason is, how do you get income, or how do you get returns in such a low yield environment? I've still not gone to high yield funds. This one's going to have more volatility for sure, even with the lower interest rate risk. Yes, I think it would. Standard deviation of 9. B&D, I would think, is lower than that. Much lower, I would think. But yeah, 3, 4. So it's a trade-off. I just think they're two totally different funds. I think they're hard to compare in a way. You also mentioned VWEAX. Let me just take a quick look at that. It's funny, for years, the bond side of the portfolio didn't get much attention. It was like, let's just throw it in a B&D or some sort of general bond fund. But then when interest rates went so low, it's like, wait a minute, what are we doing here? We got to come up with something to offset that. So I get a lot of bond questions, and I need to come up with like a solid answer that I can give you guys for my strategy, but I don't have one yet. I'm just being honest. So this is obviously high yield, right? We can go to portfolio. Duration is relatively short, 3.63. It's high yield, so again, we see the percentage of the portfolio in these lower grade bonds. And its performance has been decent, like you'd expect. It's had some years where it was negative, but overall it's done well. But it's all relative. So I guess at the end of the day, certainly having some high yield in your portfolio is perfectly fine. I think the question is, do you stick with it? Because it's going to have bad years. It's going to be a little more volatile. But if you stick with it, I guess my foundation for bonds is what Swenson wanted to do. David Swenson, who passed away recently, ran Yale's foundation, and he had half the bond portfolio in treasuries and half the bond portfolio in tips. And that was sort of his starting point. And that's kind of where I start. And so high yield just hasn't been a part of it for me. Maybe it should. This is not nice. Vinyl One Earthlink said a second channel. I mean, I think this is from a while ago where I talked about a channel on making money online is not good, but this channel needs more pizzazz. I don't know. I don't know how to make it flashier. Maybe it color my hair. I don't know. Tyler would be very interested in how to make money online. The problem with asking these questions is that I'm going to get 12 different answers. Yes, no, no, yes. Are premium accounts like Morningstar worth it for amateur investors? Tiger Jaw asked that. Honestly, no. And I actually let my premium subscription expire. It does give you some tools like X-ray where you can put your portfolio in, say, of mutual funds or ETFs, and it'll X-ray the portfolio and actually show you the percentage that you own of the individual constituents in those portfolios. So here's how much Apple you own. Here's how much Microsoft you own. It's interesting. It doesn't really affect anything. You look at it, you're like, it's like going to Mount Rushmore. You go and you look at it, from vacation, they get to the Grand Canyon. It's like, okay, there it is. Wow. And then you move on, you're hungry. So you got to go eat. It's kind of the same thing. Now you also get, and I'm looking here, I can show you fund analysis. So I go to fund analysis right now. It's probably going to say, yeah, see this little plus sign. Oh, and now I get to pay for it. I honestly have never read fund analysis from Morningstar in my life. And it's not that they're bad. They could be great. But I just have never found a need for it. So I don't think. And I've done a whole series on Morningstar. I think it's a great tool. And they're an affiliate. I can make money if you click one of my Morningstar links and sign up for the premium. I haven't made much. It doesn't help that I don't think it's worth for most people. Now, I've been using Stock Rover, and there's a cost there as well. I don't know what it is off the top of my head. I like Stock Rover. You got to spend some time with the tool. There's so much to it, but it's a lot different than Morningstar. Again, do most people need to pay for Stock Rover? No. Mm-mm. Particularly if you're a buy and hold index fund investor. You don't need it. That's my opinion on those. Is 80% VONG and 20% FUTY better than S&P 500? I don't know. I don't even know what FUTY is. Fidelity. Oh, utilities. I've been getting this question a lot about utilities as an alternative to bonds. They're not an alternative to bonds. They're different than bonds. They're riskier. They're more volatile. They may be a perfect investment, a perfectly reasonable investment. But they're not. They're different than bonds, and that's what happens when yields are so low. We start to reach. They call it reaching for yield. You go high yield. You go emerging market debt. You go utilities. It's not that there's anything fundamentally wrong with these investments. You just have to understand that they're different, and you can lose money, right? You can lose money in bonds too. Most large sort of intermediate term bond index funds, by and large, are not going to lose money very often on a year-by-year basis, but they will. We saw BND had a couple of years where it lost some money. This particular fund has done well. I'm looking at performance. This is Fidelity MSCI Utilities, ETF. It's done well in the sense of it's only lost money twice since 2014, once in 2015 and then a little bit last year. And if we look at risk, it's going to have a standard deviation, I would think, below 10. And I would be wrong. 15.64. I don't know how this is measured. It's over the last year. Doesn't say. My guess is it's over the last year. But in any event, yeah, see, these are risky. Again, doesn't make them bad. They're just not a bond alternative. I think it's wrong to compare them to bonds. But that's not what you're doing. You're saying, how about that plus the growth fund in place of an S&P 500? I mean, you can put it in Portfolio Visualizer and see what you get. Personally, I would just go with an S&P 500. I can't say that what you're suggesting isn't reasonable and that you might do better. I just, the more interesting my portfolio is, I think probably the riskier it is. I want it to be boring. I don't want to live in interesting times. All right. Here's one from Lewis. Do you think it's smart to invest in, I guess, Shiba Inu? Have I got that right? Coin at the moment. I invested in that coin today. I know. Please don't unsubscribe from the channel before you hear the story. I bought some today. It's true. And no, I think it's a dumb investment. So in my Coinbase account, I have $2.07. And it's from watching a couple of videos, I don't know when, where they give you free something, compound, I think it's called. I don't even know what that is. And I logged in today because I read about, these millionaires that have been minted from this coin, which is a parody of a parody. They say Dogecoin was started as a joke, but was it? I mean, its name was a joke, but it's a crypto. I mean, if it's a joke, they're all jokes. Yes, they're not all the same. Some are capped, some aren't. They're different in some ways. I get that. But it's a joke. Why? And why are all the others not a joke? Maybe the naming of it was a joke. In any event, yeah, I bought $2.07 worth. Kind of as a joke. But no, I don't think it's a good investment at all. That's my opinion. I just, it was either that or transfer $2.07 to my bank account. Probably should have done that. Do REIT ETFs dividends in a taxable account count as qualified dividends if you hold them for more than 60 days? Great question, and the answer is no. Ordinary income. That's why you should not own REITs in a taxable account. The deal there is, corporations have to pay tax on their profits. Then they distribute the dividends to you and me, and assuming it's in a taxable account, we pay tax all over again. The way it works. REITs are able to avoid paying tax at the corporate level, but they must distribute 90% of their income. There may be some exceptions, but roughly 90% of their income to shareholders. And shareholders get hit with, they get treated as ordinary income. I mean, the government's going to get their money one way or another. So yeah, you by and large should not hold REITs in a taxable account. All right. Steven says, I've DCA'd since 2003. I'm 50. I have enough to retire comfortably. Congrats. You should be doing this show. Comfortably, even using the 2.5% rule. Nice. I'm 80-20 now and want to preserve. Any advice about distribution in this pricey market? I don't follow that question. How to take money out? So you might have to put another comment in so I understand your question. Vinyl says, Citi is a complicated company, period. Thousands of quasi-independent fiefdoms. Yeah, it's complicated. What? Vinyl says the Money Guy show, by the way, I know the guys, I see them every year at a conference, is an example of a show with more pizzazz, but they have creative teams supporting them. I got nothing. This is what I got. I kind of want it that way. I don't want a team. I don't need a team. I don't want pizzazz. Money Guy show, they've taken all the pizzazz. There's none left. The Money Guy show. I'll have to talk to them next year. I just saw them a month ago. So these are hard questions to answer. This is from Malay. What is your opinion about the difference between actively managed GNMA versus index GNMA funds, Vanguard VFIIX versus VMBSX? The problem is these are not, I'm aware of these funds, but I don't have details on them. To give you an opinion on that, I'd have to do research beyond what I could do in this show. So you can email me that question and if you want to, and I'll try to dig into it. Charles wants to know, what do you think about DCA, dollar cost averaging investors holding 10 to 20% in cash to take advantage of market contractions? Well, it depends. If you're investing in individual stocks, I'm always trying to buy something that I think is undervalued. If I find that, like I did last year, in banks, I'm going to buy it. I don't care what the market's doing. It's undervalued. If I think it's undervalued, it's undervalued. Now, if you're talking about sort of like index fund investing, we get the 1700 problem. That's what I'm going to call it now. Remember the email from you said you joined the show late, so you may have missed this, but Someone emailed me and said they pulled their money out. This was back when, I don't know if this was 08, 09, or maybe it was the pandemic last year. And they were going to go back in when the S&P 500 hit 1,700, and it never did. And now it's at 4,500. So you can set these ground rules. Well, it's at 4,500. Is that what it's at today? Let's see. 4,581. I'm not going to go back in until it's 4,000 or whatever. Or you could just say, well, I'm going to wait for it to drop 20%. Well, that would be even a greater drop, right? Yeah. Or 10%. Well, 10% would take it to roughly 4,000. But what if it, well, at some point, maybe it does, but you could be waiting a long time, maybe not. So I tend to think for the index fund of my portfolio, I'm not market timing at all. You know, if I've got a 401k, it's going into whatever my asset allocation is. I'm not holding anything back. For my individual stock portion, I'm waiting until I find what I think is a reasonable buy. But there I'm buying individual stocks. If you're going to hold back some cash, then you've got to define when you're going to go in, and you've got to realize that could be problematic. It's so high now, if you say, well, I'm going to wait for a 10% correction, that doesn't strike me as unreasonable, and maybe you do well with it. I just don't think that way with my investments. It may work now, but then what's next time? Then what? And at what point do you hold the cash? When it gets to what valuation? Is it a PE-based analysis? It just gets tricky. Tom says, I just started a Roth IRA with Fidelity. He's got 60% in FFNOX. Let's look these up real quick. Fidelity 4-in-1 index. I've never heard of this. I have no idea what this is. But I like the name. I don't know why I like the name. Low expense ratio, so it must be index funds. Is that what it is? 4 index funds? It's a balanced fund, right? It's got 14% in bonds, and international, it's got to be 4. That's probably what it is. 4 funds, right? Let's see. Whoops, hang on. No, this is right. Yeah. 4 funds. So, okay. I mean, that could be a total portfolio right there. You could just stop right there. 10% in FQIFX. Fidelity Freedom Index 2025. So I assume you're retiring soon-ish. But that's very similar. We can look at the portfolio, but it's going to be that's not true. It's going to be more conservative. It's got more in bonds, but same concept. 10% in FSKAX. Is that their total market? Yep, that's total market. FSMDX, mid cap. All right. And I'm guessing the next one is small cap. Whoops. FSS index, small cap. So, I mean, I think that you know, that portfolio would work. You know, I'm assuming you're near retirement. I'm guessing. That would be a question. I would probably put this in either personal capital or Morningstar and look at your overall asset allocation. You could even use Portfolio Visualizer, right? If we go here, this was just, if you put your portfolio in with the percentages and then you go to exposures, it'll show you your exposures. And I'd particularly be interested in the overall stock to bond exposure. There's some overlap in there. I mean, you know, honestly, depending on what asset allocation you wanted, just FFNOX might do it. But that assumes it's got the stock bond allocation you want. Daniel says you can earn interest on Shiba Inu, and I don't even know if I'm pronouncing that right. If you buy Voyager, I have no interest in. I shouldn't have even told you I bought $2.07. Of course, I could be a millionaire now. I mean, I just bought that like a couple hours ago. So who knows? Maybe maybe this will be the last show on the YouTube channel because I'll be too rich and famous to deal with you guys. You know, I doubt that's going to happen. Hang on, two-factor authentication. Here we go. I've probably been wiped out. I got nothing. The whole $2 is gone. $1.87? What? Stupid crypto. Okay, Stephen, when I referred to distribution, I meant where should my money be invested now for preservation? Well, and I'm not going to go back up in the chat. I think you were 80-20. So a preservation portfolio, some would say like 60-40, 50-50, somewhere in there. Others, though, would say now's not a great time to allocate so much to bonds, right? Of course, some would say it's not a great time to allocate stocks. So I guess you got Shiba Inu. Just kidding. You know, if I recall your comment, you can live comfortably on 2.5% of your portfolio, which basically means you should never run out of money, even adjusted for inflation. At least based on Bengen's work, you'll die with more money than you have today if history repeats itself. So personally, I would be very comfortable staying at 80-20 or 70-30, but I'm not you, and you're not me. So, you know, when they talk about preservation, it's somewhere around 50-50, 60-40, 40-60. That would be, I think, when most people talk about preserving, that's what they're talking about. You could even, some would even argue more conservative than that. I personally wouldn't. If you look at some of the target date retirement funds, once you get past the retirement date and 5 years past, they have, so target date retirement funds, you know, they talk about the glide path, stocks versus bonds. The glide path is how your stock bond allocation changes, and your stocks go down, the allocation to stocks, as you get near retirement. We're going to call this retirement. We're flying in. Stocks get lower and lower and lower. There's the two glide path where once you retire, you land and you stay at that allocation, you know, until you die. The through glide path, you actually go down and you crash through. Okay, you don't crash. You glide past, and you keep changing your allocation even after you retire. Not forever. I've seen it maybe 5 to 7 years, and then you land and you keep it. So a lot of these most of them, target date retirement funds today are through glide paths. So your allocation will continue to change even after your retirement year. So if you bought the 2020 fund and you retired in 2020 and you keep your money in that fund, the allocation is going to continue to change for another 5 or 6 or 7 years, depending on which one you have. And they get really conservative, like 30% stocks. I think that's too conservative, but some would argue that that's preservation territory. I'm not sure about that. So, you know, I mean, look, this isn't financial advice. These are my opinions. And notwithstanding the lack of pizzazz, this is for entertainment purposes only. All right. But yeah, I would say somewhere around 50-50, people would call that a preservation, maybe 40-60. I wouldn't go that conservative, but. Salty says the only way to talk intelligently about crypto is to try investing. I don't agree with that, but it's okay to disagree. You will be able to voice your experience with the tools and the entire process, including side costs. Yeah, that's true. But Warren Buffett talks about investing in crypto, and he's never invested in it. I think he can talk intelligently about it. I think I can too. Although maybe I've crossed over now with my $2.07. Hang on, let's see if it's gone up from 187. 189. It's a comeback. It's a comeback story. I've made it to the end of the chat. There's still 214 of you watching. Okay, now it's puzzle time. My puzzle rating has not done well this past week at all. I told you my blitz rating, I think I told you, went up to over 2,000. Very proud of that. But the puzzles, they went down. Here we go. See, look, I was over 2,900 last week. Now I'm down to 2,810. Here we are. What do you guys think? By the way, if anyone has any last minute questions, I am still monitoring the chat. I'm always curious to see how many people abandon this live stream after I put the puzzle up, but it kind of holds strong. The rest of you probably kept your computer on and you went to lunch. So let's see, queen e4, knight e3. I can check on d3, but he just goes to f3. Of course, I can take the knight. That looks like a decent approach. Let's see though. I'm already down a piece and a rook. I need to mate. I can't win a knight. This needs to be checkmate. Oh, I see it. All right. You guys got it? I think I've got it, right? Because I think it's here. And then we get this guy in there. Boom. And then that's checkmate. All right. Look, 3 in a row. I must have answered 2 correctly the last time I played. Doing great. They're so supportive at chess.com. All right, next one. So this is one thing that chess.com does. I've seen this puzzle before, and I got it wrong. And so they will occasionally bring it back to see if you remember what you did wrong. And the issue for me was, now I've got to remember what I did, what the answer is. Because I looked at queen here, but you know, you can just take the pawn. Now I got to remember the answer. I'm pretty sure it's queen here. Yeah, and I expected that, but then I think I did. Oh, what did I do wrong? Oh, I know, it's this. Yeah, I knew that. And then you just come back. So I got that one wrong again, twice in a row. That's okay. That's how you learn. This is kind of a weird position because this rook is in an odd place. And of course, this rook is pinning my bishop. I could try to push the pawn here, right? Because this bishop is pinned, but he'll just go there, check, and then win my rook. So that's not good. That would be bad. Well, actually, he can't. What am I saying? I'll just take the bishop. But then he could come down here with his rook. No, he can't, because then I've got checkmate. I'm going to try it. Any answers? You guys aren't helping me at all on these problems. I do have a question. Do I get money back in my tax refund if I contribute after-tax dollars to a Fidelity HSA account? Yes. Yeah, you can. So most of the time, I think it's probably most common to have HSA contributions taken out of a paycheck. It's convenient. Oftentimes companies match, and you not only avoid income tax on that amount of money, but you also avoid the payroll taxes. But if you do it on your own, yeah, you could deduct it. And there's a lot of benefits in investing in HSA. Obviously, you get the tax deduction. It grows tax-free if you use it for eligible medical expenses. You can use it tax-free. You don't have to use it or lose it. You can keep your balance and grow it for years. You can take it out for non-medical reasons. You'll pay taxes, but you won't pay a 10% penalty if you wait till you're 65. It's not 59 and a half, 65. Yeah, so I love our HSA. Okay. Oh, that's interesting. I don't get that move. I see, because if I take here, then he can check. No, that still doesn't work. No, yeah, he can check here, and then he wins this rook, right? But I can just take there. All right. Just checking the chat. So you guys got that one right. Good going. I always look at captures and checks. So like I could take this bishop with the rook. It forces the, oh, it does. Yeah, it does. It forces the king out. I've got a check here with the queen, but the follow-up seems kind of hard. Then I think, well, can I trap the queen? Because rook here, no, he's got a check down here. Got a potential check down here, so I can't even take that rook because he would check here and mate me. So that would be bad. Generally, you want to avoid checkmate. I mean, I can take with the bishop, but then he takes back with the queen. So if I move this queen to here or here, I'm attacking the bishop with check. Am I doing it? Oh, if I move here, I've got two threats. I can take this bishop. I've also got a check here, over here, which would cause white some serious trouble. I like queen here. Now I'm looking at the chat. Yeah, you guys are debating. I can't take the bishop because it's checkmate, right? Yeah. I'm gonna go. I gotta be my own person here. It's my score that's on the line. I just gotta do what I think. I could be wrong. Oh. Well, now don't I just win the bishop? See, when they do that, it's like, okay, what's the trick? Because if I take the bishop, material's even, right? It's not like I am threatening this rook and the knight. I'm taking it. Oh, see, now I didn't see that. I did not see that. But I'm okay. I get lucky. I have that. And now the knight is no longer guarding Mr. Rook. Of course, as soon as I take it, it's the wrong move. So I have to think, I'm going to take it. There we go. All right, I'll give you another puzzle while I actually answer a question. My wife is starting a W-2 job in December. She has a 1099 job now and didn't contribute to retirement yet. What should she do to try to max her contributions before next year? Well, she's going to start December 16th. Presumably she'll have a 401k, right? But it's December 16th, so I'm going to assume she's not going to be able to. I mean, I don't think you can contribute that fast. I'm looking up. You can't see me. I'm looking up. I don't think she could contribute. So anyway, well, she could obviously just start a regular old IRA or contribute to one, right? If she has enough income to justify it. You could look at a SEP IRA, where in theory, depending on her income, you could contribute more. The SEP IRA contribution limits are $58,000 for 2021. But it's not that simple. It's based on a percentage of income, profit, or I don't know if it's profit or income, but a percentage of your, what you've made in the business. So a SEP IRA may be a way to go. You could do a solo 401k, but which is an option, particularly if you can put more in a solo 401k if your income from the business isn't enough to max a SEP IRA. So you could look into a solo 401k as well. Yeah. All right, back to the puzzle. Let's see. So it's black to move. I'm down a piece and a pawn. And it doesn't look like I have any checks. I could push this pawn and threaten checkmate. The good news is white has no checks. So I think the queenie would have to go here to prevent checkmate. I could push check, but he could take it. And I don't see what that gets me. But this pawn push doesn't, can't he just take? What do you got? H3, then G3. Well, H3 followed by queen F1 followed by G3. What if he just takes with the pawn? I don't have mate. I can check him. I can check him on E3. He can't interpose the queen at F2, right? Because then I would have H2 check, king to G2, H1 queen, king takes queen, queen takes F2. So maybe that is the answer. But he doesn't have to interpose the queen. He could, I don't know, just go to H2 with the king. Now what do I have? Oh, wait a minute. I just take the pawn. If he takes FG, I could take the pawn at G3. King's got to go to H1. I still don't see what I have. I don't have checks on G2 or F3 because of the queen on F1. H3, G3, H2. Yeah. He's going to take. I can do H2. Dun, dun, dun. Dun. H2. He'd just take H2. He'd just take the pawn. Oh, no, he can't take the pawn. The queen would be. The queen, he's got it. You're right. I think Salty's got this one. Because he can't move the king. All right, we're going to go with Salty's solution. Look at that. You saved me 5 points, man. I appreciate it. How many viewers are we down? Oh, we're still doing pretty good. All right. I'll play a couple more. We've been on this thing almost 3 hours. How am I going to do the timestamp? Maybe one of you want to listen back to the whole thing and send me the timestamp. All right. Black to move. Well, the immediate thought is queen H6 check. King's got to go, well, that's not true. He could interpose one of the rooks. Well, probably not the E rook, but let's just, yeah, that's tricky. Maybe that is the move. If he plays rook E1 to E3, then I've got rook H1 check. He's got to go to D2. Yeah, boom. Yeah, I don't think he can do that. And if he uses the C rook, then I've got check on C2 with the rook. He's probably got to play king B1. And then I looked at rook C2. If he takes rook, then the rook is pinned. But I don't think that gets me anything. Wait a minute, boom. Boom, no. But I could play queen D2. Or rook A1. All right, I got to believe this is the right answer. The follow-up. What's the follow-up? David has a question about Velodyne lighter systems. Why is the stock doing so bad? I don't know. I've never even heard of that company. Well, I can look it up. Well, its earnings per share, it loses money at the moment. That might be one reason. Salty suggests rook E2. The thing is, I mean, I understand that he can't take the rook, right? Or it's mate and two. But he's not forced to take the rook. Queen d2 threatens the rook, but of course he could play rook c1. If I play rook h1, he can play rook c e3. This is what my day is like, sitting and staring at a chessboard. So rook h1, I think he just plays rook c e3. Yes, I can take the e3 rook, but then he just takes my h1 rook. I don't have an immediate threat. I can take his e1 rook instead. He takes back with his rook. Still don't have an immediate threat. And if I ever try to threaten c2, he can just move his rook to c1. Oh, that doesn't work. Well, yes, no, yeah, that doesn't work for me. That does not work. What do you guys got? I don't know. Queen d3. Maybe you mean e3, because I can't get my queen to d3. But can't he just take it? Rook c3 takes the rook. I know he's got a check or something on c2, but I looked at rook c2, rook takes rook, and the rook is pinned, but I can't really see what to do with that. This is tricky. All right, what do you got? Canada, please, really? Well, I mean, I've looked at rook h1. I don't think that's it. I have looked at rook d2, but I think he just plays rook c1, right? Chess is hard. I looked at rook h1, rook c e3, queen takes e3, rook takes h1, queen e4. In theory, double attacking both c2 and h1, but he just moves his rook to c1. I don't know. I don't have an answer here. Rook e2. Yeah, people have said rook e2, but why can't he just move his rook over here? He can't move this rook off the back rank. I could take his pawn. It's probably not the answer. Probably not the answer. I can't really hit this queen anyway that I can think of, and it's out of play at the moment. What am I missing? I mean, okay, we're just going to do it. And then we're going to do this, and that was wrong. Ah, interesting. I don't think it's taking that pawn, is it? No, that can't be right. I've gotten this far. Take the pawn. Take the pawn here? That can't be right. Don't know. All right, it's hint time. Oh, we're moving the queen. Yeah, that's not right. What are we missing? I got nothing in the chat. I could attack that rook. This is tricky. Nope. This is a tough problem. Come on. I don't know. We're going to have to end on that one. That was a tough one. I've struggled this week. Yeah, it's not been pretty. All right. Well, listen, thanks for tolerating the chess puzzles, even though I clearly was off my game. Hope this has been helpful. I will get a timestamp up there with all these problems, all the topics we've talked about soon. There's a link to the newsletter below that I send out I send a newsletter out once a week on Sundays. So join that if you think it'll be helpful to you, and appreciate all your support. Until next time, remember, the best thing money can buy is financial freedom.